Well, doing that, we'll go ahead and get started. So we'll call the meeting into order. You have a forum present, and welcome to everybody to the fourth quarter meeting. The 2025 has been a busy year. A lot going on, and first of all, to all the board members, thank you. Thank you for your work, and thank you for your service on this board. Highly compensated, right? And so, but the work is really, really important and really valuable. To our staff team, thank you for the work that you've done this year, and a lot of heavy lifting. And so with that, we'll go to item number 1, which is the minutes of the August 21st, 2025 meeting, the August 15th meeting, and November 15th. Last 2 work sessions. I have a motion to adopt to approve the minutes of those meetings. I have a motion. Is there a second?
Second.
I have a motion to take any objection or any corrections or additions to those minutes. Not extend approved with. Okay. All right. Item number 2 is a report from our Chief Executive Officer regarding the investment management and administration of the Texas Public School Fund Corporation, and the esteemed Bob Gordon, and is now eclipsed 2 full years with us. And welcome aboard.
Thank you, Mr. Chairman, members of the board. Good morning. I think we were commenting that a year at the PSF is kind of like a dog year. So it seems like about 4 years. Certainly the amount of progress that we've made. It's like 2 years worth of work. I'm very proud of that. I'd like to touch on just an update on our strategic plan and highlights of our investment performance. We are having a bit of technical difficulties on the general screen right now, but for the members, if you refer to your diligent books for this section, so the general slides up, that's what I'll be following. What I really want to cover today is the fund performance and update on credit ratings as it relates to our bond guarantee program, evaluate the recent progress against our strategic plan, and highlight some upcoming initiatives in the strategic plan. Our strategic plan, as you know, is kind of evergreen. We have both short-term, intermediate-term, and long-term tasks in there, so it's kind of a rolling plan. But each year, the staff is refreshing it as best they can to identify, things that are rolling off as completed, and adding new initiatives as we go along the way. We presented a rather robust review of this yesterday in our planning and budget meeting, and I want to focus on just some near-term initiatives that we'll be tackling by 2026. The bottom line here is the capital markets have been incredibly robust. We have had a lot of tailwinds and expansion across the board in many of our asset classes, and the broad macroeconomic picture continues to still look positive. We have steady and returns that are in excess of our policy benchmark, so we're generating the excess returns we would like to, while at the same time we are regularly identifying Texas-based and Texas headquartered strategies that are additive to our program. And we've really pivoted in our interface with the credit rating agencies, and I would just characterize that as historically we've been reactive to credit agencies, annual requests for financial statements and investment data. Now we are actively engaging the credit agencies. We've actually contracted with the three major credit rating agencies that are used in the bond guarantee program, being S&P, Moody's, and Fitch. We are using them to help validate scenario testing that we are doing to make sure that we are understanding all the nuances of their credit rating models and how they view our credit rating. And we've actually had some real breakthroughs on clarity and better educating the credit rating agencies of the workings of the PSF and the role of the TEA in managing the bond guarantee program. So I think we're really upping our game, how we manage our credit ratings. Our mission, is twofold, and the mission being to generate stable, risk-adjusted returns that are hopefully growing so we can have ever-growing distributions to the available school fund, while at the same time being the AAA backer of bonds issued by school districts. That has a natural push-pull effect because higher returns would dictate more illiquid assets in the portfolio, looking more like our peers in large endowments. But a AAA rating would encourage less illiquid investments and more liquid investments. So we manage that trade-off very carefully. And our job is not to avoid risk. Our job is to manage risk. And what we want to do is assume an appropriate amount of risk. We want to assume compensated risk. If we don't think risk is well compensated, we won't take it. We want to assume as much compensated risk as we can under the constraints of maintaining the AAA rating. So that's the real activity in our risk committees that we're focusing on with ever increasing attention now, and engaging the rating agencies is certainly helping our understanding and dialogue and ability to do that. So highlights on our six major goals. The first one being, optimizing our asset allocation. Recall that one of the first things we did when my tenure started is we created this strategic plan, and we took a large step in changing our asset allocation to look more like our peers, the 25 largest endowments in the country, which is a reminder, we are by various measures the single largest in education endowment in the country. So we certainly want to be investing in ways consistent with the largest and best endowments. That step that we took has been largely completed, and we're looking at taking the final step towards that in Q1 of 2026. So we've been working with NEPC and the rating agencies to underwrite our kind of final, strategic move in our asset allocation. I would expect going forward it would be much more steady state disruption. I think the macroeconomic outlook that we are facing today, we've got positive economic growth. The earnings in the S&P and really broadly across all equity asset classes have steadily trended towards upside surprises and certainly meeting estimates. So those are two very strong tailwinds. The broad economic growth that's resulting in earnings being generated. A headwind is inflation, but currently it's rather stabilized as of late. It's kind of going sideways. The only bit of a drag is, some expectations that unemployment, may increase. We see some signs of slowdown in certain parts of the market, but in aggregate, it's still a net tailwind, and we're expecting continued positive returns under this kind of environment. To illustrate these tailwinds and how strong corporate earnings have been, I'll call your attention to page 7. Our U.S. large cap equity allocation, which is one of our larger allocations in our book based on the S&P 500, has a 1-year return of 17.6% and a 3-year return of 25%. That is versus our long-term expectations of about 5%. So we are certainly outperforming our expectations to a great magnitude. The implication of that is I think we can expect, in the coming 3 to 5 years that we'll likely have some muted performance as the markets have really run up very high. And we're also seeing this very marked bifurcation in the markets. Of this 17.6% return last year, the Magnificent Seven, so-called tech companies that are really represent the big artificial intelligence bet in the markets, are up 38. And they represent about a third of this benchmark. The economy is about still with the so-called S&P 493 that had a 13% return. So still positive, still exceeding expectations, but really led by the expansion in AI. And so you see that also in our international equity portfolios up 16%, our liquid private equity holdings, which is basically a small cap, up double digits. These are all in excess of what we would have expected. On the corollary, I look at core fixed income up 2.88%. Our expectation there is 4.8. So we're behind in that expectation, and that's primarily because of upward pressure on interest rates. We have two components to bond returns. We have the coupon return and the change in price. And as rates go up, it reduces the bond's price. And that's really what is driving that 2 percentage point. All in all, very strong tailwinds. I'm going to quickly jump ahead to page 12 to just show how all this sorts out. You'll see the total plan return versus the board-approved policy benchmark. The dark blue bars being our total plan return, the light blue bars being our policy benchmark. Positive in all of these periods, 1, 3, and 5, and 10 years, exceeding the benchmark in all of those periods. And this is kind of remarkable. This shows, very steady tailwinds and expansions of the capital markets. I would say we were very fortunate to have had this environment when we were moving so much money around in the last 2 years. It's really been beneficial that we were not caught out in the middle of some crisis or repricing. But every year that we continue to exceed our return expectations, it increases the probability that we would expect some muted returns and some pullbacks in the market. It's hard to say when or whether that's going to be gradual or whether there'll be something that kicks off a sharp sell down. To that end, one of the things we've been working on greatly is our risk management systems. Recall we retired the old Aladdin risk management system. We installed a new Barra risk management system, spent the better part of the summer populating that with the vast amount of inputs required for it to function. But we are now able to model our portfolio under a variety of circumstances. And we're developing a plan, and I think, Member Thomas, you had brought this up specifically, like, do we have a kind of a fire escape plan, if you will? If a sharp crisis hits us, where can we find liquidity and how will we pivot? And so we're working on developing that plan. The time to develop it is when you have steady trending markets and tailwinds. So you do have the emergency plan that when it happens, we will be prepared. And we will be bringing that ideas and that roadmap to the board in 2026 to kind of outline that and hopefully position us that if we do have a dislocation, we can take advantage of it and have the liquidity to buy into assets that are oversold. Pivoting back to the bond guarantee program, all three rating agencies reaffirmed our AAA status last year. Some of the commentary you can see here in their write-up. on the program. And I think it bodes very well. Particularly, I want to point out Fitch's comments that the school district oversight in Texas is viewed as exceptionally strong when compared nationally. And I think that really bears out in the fact that we have a 40-year bond guarantee program with a default history of 0.0%. So exceptionally well structured and exceptional oversight in that program. As a matter of information, we have this map of the bond guarantee issuances that we're backing, and you can see these little blue dots represent where they are. The size of the blue dot is the aggregate size of the outstanding debt. Naturally, you see that clustered around the major population centers in Dallas and Houston and the greater Austin, San Antonio corridor. But you also see it across almost every district and county in the Panhandle and West Texas, everywhere. So the bond guarantee program truly reaches statewide, and it provides savings to school districts on the order of $500 million a year in reduced borrowing costs because they're able to use the power of our balance sheet to back this debt. So it's a very powerful mechanism to support public schools. The growth in the bond program, though, is something worth noting. You'll see in this blue line on this chart shows the growth in outstanding bonds. The red line is the net growth of our portfolio, which is the gross returns minus the distributions that we make every year. And of note, the bond guarantee program has been increasing at an increasing rate. We've got 3 periods here, an 8-year compound annual growth rate of 5.8% going back to the 2005 to 2015 era. That 5.8 goes up to 7.1 in the ensuing 8 years, and now is almost 11% in the last 4 years. And that is something we keep an eye on because it's the red line that backs the blue line. So there is a limit to how much that can grow. We still have a lot of headroom, but this is something that we tend to collaborate closely with the Texas Education Agency, Board of Education, to make sure we stay way in front of that. Yes, sir.
Do we have a sense of the next 4 years or 8?
In terms of bond issuance, we don't have a specific projection. And I think that is a very worthy question to explore a little bit more with the TEA is actually the arbiter who approves those issuances. And I'd like to say that I want to report back with a more fulsome answer, but certainly, the trend is real.
Said this, Bob, but what's the space right now as far as what we could be backing and what we are?
Well, we have 3 rating agencies using a multitude of different measures. So, you can calculate that, about a dozen different ways. But generally speaking, and maybe Jared, if you want to,
30 billion right now for the current.
In aggregate, about another 30 billion.
Okay.
Yeah.
For multiple.
That's not statutory.
Correct.
That's right. So we have multiple limits. The IRS and Department of Labor years ago gave us a very generous level. That was like basically 5 times our balance sheet. The Board of Education adopted a little more conservative limit of 3.5 times our balance sheet. But what really drives it is maintaining the AAA. And that level is actually lower than that 3.5 times. And we estimate in aggregate, it's about $30 billion. And we're telegraphing that to the TEA. And this is just like we're improving the dialogue and interaction with the rating agencies. I think we're improving the dialogue and interaction with the TEA. So the right hand goes with the left hand.
Growth rate, we would be $30 billion less than 3 years.
Now, there are conceivably other levers that can be pulled because we can do wrap insurance guarantees for these bonds. We don't have to necessarily. But for a modest cost, particularly for some of the stronger school districts, they can buy a AAA wrapper on those issuances and at a very reasonable cost. So we're exploring that mechanism. Again, trying to get way ahead of it. Let's say we get to that eventuality. What are the options? Because we'd like the adjustment of last resort to be shifting from our strategic asset allocation to have to just build liquidity, because that's going to cost us opportunity cost in the other part of our primary mission. And when you think about it, the return part of it far outweighs this guarantee program. It may even be worthwhile for this plan to actually pay for those AAA wrappers, because they're not very costly in aggregate. And the trade-off that we would get in returns is many multiples of that. So this is a spot-on exercise of something I think we will be talking about a lot. But it took getting a risk management system in place that was a usable one. We didn't have that before. Now that we've got it, we're able to really see the push-pull effect out of it. But this definitely warrants ongoing analysis and dialogue and monitoring. Just get ourselves. Our second major goal is, once we have this asset allocation set, is our implementation. How do we go about investing in this portfolio? And generally speaking, what we've tried to do, I made the observations 2 years ago that we were probably over diversified as a plan. We had too many line items. We had a lot of double fee structures and funds of funds. And what we need to do is trend towards a more concentrated portfolio that has fewer but more meaningful relationships, strategic partnerships in which we can gain economic advantage, get access to co-investment deal flows for little or no fee and carry, direct investment cash flows, even soft skills. I will say that as we were engaging the rating agencies, we had a couple of issues we were kind of concerned about, and some of our strategic partners were able to step in and greatly assist us in that dialogue, because they are major purveyors of credit ratings in all of the business that they do. And they were able to bring the top people at the rating agencies to bear on some of our issues we were working through. So these partnerships are going to prove to be very valuable. But we are turning around a battleship. A lot of these over-diversified fund-to-funds things are in illiquid structures that have to roll off over multiple years, and we're rolling back on. We just started our first cost-effective management services engagement, because what we want to do is always be able to answer the question, for all the underlying investment management fees and carry and other embedded costs, are we getting what we pay for? I.e., does paying more get you more or not? Our first blush of this is what we're seeing is our returns are right about average to our peers over looking back, several year window, but our costs are higher. So that would indicate historically we're not really getting what we pay for. So we want to pay very close attention to that and manage that metric. But it is going to be a multi-year, is probably 3 to 5 to 7 years before you've rolled enough of that off, rolled on to really see the fruits of that. But we've established a baseline, and we're going to start measuring that and reporting it regularly.
How much have we been overpaying estimate?
I think it was about 35 basis points. Sure. And yeah, 2024. So that basically these double layers of fees of funds where you got an underlying manager that you're paying 2 and 20. Now you got another manager you're paying 1 and 10 on top of the 2 and 20, and it starts. a whole heck of a lot of the return. But there was a reason why those things were put in place. And that is when this fund first stepped out into doing any kind of investing in these asset classes and really didn't have any experience in it, there was a rationale of having these gatekeepers to help guide the way in. Now that we've built a robust team and have the capabilities, we can wean ourselves from that, systematically roll these off, and day by day. The page 13 is worth talking about. This shows the impact of the changes we made to asset allocation to structure our portfolio a little bit closer to our peer group. And so this is the large endowment peer group, which you can see historically we were kind of dragging around in the basement there. And immediately upon making these shifts, you know, we see the fruits of that. And had a nice run up. As a matter of fact, even, you know, peaked, you know, way up high in the top quartile. Now, where do we think we want to live going forward? In order to target being in the top decile of your peers, you have to take such asset allocation bets that you are likely going to end up in the bottom decile time to time. You'll have a lot of volatility. So in my experience, the best thing to do is to have an allocation that's roughly approximate to your peers. Maybe you've got a couple of bets you're taking and a better implementation where you're generating alpha. And if you can do that, you can maybe live in this, you know, third quartile range. You can kind of neutralize the asset allocation, be it median, and through better implementation, be it the 60th, 70th percentile, and try to do that consistently. So that's what we're trying to achieve and what we will be measuring going forward. And if we're not doing that, we have to understand why. And, you know, do we need to reconnoiter?
But I just had what Mr. Trump said. The plan here, you know, what we're accomplishing under Mr. Ford's leadership is we'll solve that 35 basis points issue. That was sort of a good start. And as we evolve into being a well-run modern endowment, we take on the fund-to-fund role. We take it on and we excel at it. We don't need to hire someone to do that. What we are great at, choosing GPs. We need top quartile GPs. We need to drive economics from those GPs by using our scale and permanent capital. And importantly, harvesting co-investments, which is a skill set that we are building. Those things are naturally going to lead to improved performance and lower costs. And it really fits with the bigger plan around strategic partnerships, diminishing line items, and more robust use of co-invest to drive performance. But I think it'll solve itself over time, sort of a natural evolution. And I think we've covered a lot of ground in the last year in terms of putting that.
And we'll illuminate this cost effectiveness a little bit more in a moment. Just real quick on page 14. As we said, we do a lot of due diligence. We look at over 2,000 firms a year. We might hire 50 of them. And we have a very rigorous process and very, very high standards as to who we will hire. Having said that, because Texas is such a robust economy, there is a lot of good opportunities in this state. And invariably, even through these stringent filters, Texas firms rise to the top. And whenever we see that, you know, we kind of use the euphemism, tie goes to the Texan. You know, it's never really a tie because you're dozens of factors, but, you know, we think about that. And we don't invest in Texas because it's a Texas-based manager. We invest in them because they're an exceptional manager. First and foremost, they happen to be in Texas. So you see, we are consistently identifying those kind of opportunities. On pages 15, 16, this really blows up the baseline of cost effectiveness. There's the 4 observations that came out of this. There's a 4-year backward-looking study. Our policy return was 5.1%, meaning if we were just at all our policy weight index, just getting our benchmark returns, we would have made 5.1%. But the the median US public plan was 5.7. That shows you that your asset allocation was not competitive. We knew that. We've taken big steps to change that, and we're going to probably take the final step in Q1 of 26. And the recent peer group averages we just looked at bear that out. Our plan risk is right on top of the peers, so that looks good. And on the next page, you'll see our 4-year return is actually right on top of the median return. So we overcame the weaknesses in our asset allocation through superior implementation to manage to eke out, an average return at average risk, despite the policy drag. But here's the answer to your question, Member Thomas. The investment costs all in, and they do a comprehensive study looking at carries and all the fees and double fee levels for 139 basis points versus a pure equivalent cost of 104 basis points. So we certainly want to squeeze out this 35 basis points and then some. Ideally, what you want is to be higher return at equal or lower risk at equal or lower cost. That should be our goal, and we will march towards it. But this is turning around about. It will take years, but now we have a baseline, and we will continue to monitor this year in and year out. Okay, that's pivoting from our investment goals to our goal of corporate governance.
Say is the timeline where we get that battleship turned and heading down.
Well, it's multifaceted, right? The biggest chunks were changing the asset allocation, changing again. You already see the benefits of that. Identifying new managers, rolling off these contracts, which there's a lot of them that we can't do anything to accelerate it. It's just got to, roll over time. I think it's 3 to 5 years really
From today.
Hopefully what we're seeing though is progress next year and next year. But to get to where I just stated, the ideal state of higher returns at equal or less risk and at equal or less cost probably takes us 3 to 5 years to really make that game. Our goal is strengthen governance. We'll talk about this later in the agenda today. But we obviously have a robust program we put in place, 3 very strong committees in audit and ethics, budget, comp, and strategic planning and policy. We have been spending an inordinate amount of time going through all of our existing policies and refining them. And in fact, later today, you will consider the first ever board governance policy for improvement. So we've really put some structure around governance here. What are we going to be focusing on? Next year is more feedback loops from the board and its own self-evaluation, and really testing out the efficacy of these policies. In the strategic plan area, though, we've really systematized our strategic plan. We're regularly reviewing it. We have quarterly reviews with the planning and policy meeting. We're establishing key performance indicators and metrics and dashboards to really help us monitor our progress on execution on the plan. The critical goal of attracting, developing, and retaining talent is really what's going to make or break this organization going forward. We started with about 100 employees. We whittled that down to about 80, really kind of, making sure that we had the people with the right culture, the right drive on the team before we built around it. We are now systematically building out the rest of the team. Obviously, we talked a good bit at the last meeting about finishing out the C-suite and hiring a general counsel and chief operating officer. We are now at about 89, 90 in our head count, and we will continue to hire, but we are trying to be very, very methodical about that to make sure we've got the right people. We've got a lot of interaction and positive results from working with the universities. The caliber of our internship program is night and day difference, and it's looking to be even more stunning in 2026. We've been able to hire a couple of interns in permanent positions as well, which is a great way to, have battle-tested, proven employees that are going to be a fit when you hire them. So I look to the internship program will be a farm for us for the rest of time in developing talent. We've launched training of all of our employees, both in the technical space and making sure that everyone has baseline skills in spreadsheets and presentation software. And now we are launching leadership training, leadership skills, management skills, all the soft skills, make sure that all of our management team has the tools to be good leaders. In our employee retention goal, we are spending a lot of time individualized career development plans for every employee, and it's tied to the strategic plan. Our implied contract with an employee is we will assign specific parts of the strategic plan for an employee to achieve. We expect them to give selfless devotion to the cause for that plan and give everything they have. For that, though, we will take a vested interest in developing their career and their talent. And for each employee, we have customized plans on the specific job experiences that they're going to have, job rotations, continuing education, professional certifications to grow the team's talent along the way. And we've been successful already in migrating some people around the organization and moving up as they show that they can really rise to the occasion. The goal of enhancing communications. We've been spending a lot of time trying to reach out in concentric circles to our stakeholders. Just in basic communications, the monthly newsletters we're now sending to the board. We're sending the Board of Education quarterly newsletters. We've redesigned our website to have a lot more transparency and ease of use, where we have links to our meetings, we have links to our policies, we have links to our financial statements, really being as transparent as we can, improving our digital presence in things like LinkedIn to really help build our brand, and continuing to outreach and speak to other groups, an example of which tomorrow Chairman Maynard and Member Perez Diaz and I will be on a panel in front of the Texas Association of Rural Schools to talk about the PSF and broader things.
Rural and mid-size.
Arms, right?
Yeah.
Arms. And we've done several of those. We've also hosted the local CIOs in our offices here and doing some town halls with some of our strategic partners, and a community outreach program where we are actively involved in local schools in several ways, doing a lot of volunteer work, doing Shark Tank kind of exercises, raising money for backpacks, all kinds of things, just to, start building our presence as a good corporate citizen and our brand. Fortifying internal controls are our sixth goal, and one that we really led with, right? Because I thought it would be a big risk to this enterprise if we were going to come and build a bold new, asset allocation and implementation and teams and everything if we didn't have the internal control structure set up ahead of it. Never wanted to be in a situation where we're chasing, internal control. So we led by creating an audit department, recruiting our chief audit officer, hiring KPMG for the first time to supplement the work that had been done by the state auditor's office. KPMG has been a fantastic addition. I'll point out one employee in particular volunteered my first day on the job. I had an all hands. I asked for volunteers to help build the audit program. Ms. Alice Felch raised her hand. And she did the RFPs for the search for KPMG. She led the search for the chief audit officer. And when we had an opening in our controller position, I'm happy to say here after 2 years, she's now the controller of the organization. It brings an audit control mindset to the accounting department. And a great example of providing opportunities for growth, within the organization. In IT, one of the things we've really focused on is consolidating applications. We had dozens of applications that, were kind of acquired, in a vacuum to solve 2 or 3 things. A system that could do 12 things was bought. And then someone else would need to solve 2 or 3 things by a different system that could do 12 things. And you find out you got 27 systems and you probably could have done it with 8 or 10. So we're unraveling all that. As you can imagine, that's not easy because it's like decommissioning and reinstalling and repopulating new things. But we've already cut that from 27 down to 11. Much better systems, much more efficient, and yet save less costly. $2.5 million run rate of savings there. I will just say something else about the progress in accounting as led by Alice. We were awarded our first Government Finance Officers Association Certificate of Excellence in financial reporting. And we've again had clean audits and look to have another clean audit opinion again this year. And importantly, we engaged getting ahead of things, Mercer and Alborn, to really review all of our workflow processes in finance and make sure that they were efficient, but had adequate checks and balances. They made a lot of recommendations. We were implementing all of them. And we've actually engaged Alborn too in another way of auditing all of these management fees, these very complex multi-layers of fees on these, hundreds of line items. We are going back and making sure that this high cost that we're paying is accurate too. And that, as you can imagine, is a significant undertaking. And Mr. Chairman, that pretty much concludes my comments on our strategic plan update and performance.
Okay, members, questions from the board? What's so? Bob, for the and members, at any time if you've ever gotten questions between to pick up the phone. Those conversations. Okay, we're going to move on to our next item, and this is something that's been in the mix for some while, and that is that I'm very proud that that this board and this organization has taken a very forward stance on how we approach proxy voting. A lot of people don't. This is one of these sort of obscure, arcane things that most people have no idea, and how a lot of things get driven in corporate America through proxy voting. And this is something that came to our attention and also the attention of the legislature. But Jerry Boyer also became very aware of this and how some decisions were being made that were really contrary to stockholders in terms of things like return, or had nothing to do with return. And in some cases, we're actually working against those things that actually provide inflows to the fund. I always remind people that the permanent school fund is not only the assets that we manage here, but also the assets that are managed by the school land board that create inflows into the fund. And so a lot of things that were being driven in corporate America were really contrary to that. And so we had the opportunity to partner with Jerry Boyer, and who created a matrix of sort that would put us in a much better posture in making sure that the votes, so that the shares, when we are voting our shares, that those votes are consistent with the interest of the school fund and our mission. And so Jerry comes to us from Pittsburgh.
Correct.
And welcome. And love to hear your report.
Thank you, Mr. Chairman, and other members of the committee and staff. It's a pleasure to be with you in person this time and to talk about the proxy voting audit that we produced for you. We have that document with you, 9 pages in length. So just to zoom out a little bit, kind of reset this, when you are the direct owner of shares, that confers numerous benefits. You to sell, hopefully at a capital gain, and a vote. And that vote function tends to be neglected, tends to be ignored. And what's happened in that situation where it does not get a lot of scrutiny, the system that votes shares made up of proxy advisory services and the industry that supports that had kind of gotten into a situation where they had maybe drifted away from an exclusive focus on shareholders, which we believe is the fiduciary responsibility of a voting entity. That if their job is for the benefit of the beneficiaries, the way you benefit beneficiaries, we just heard a detailed report about the strategic decisions that the fund has made in order to maximize returns. And if you're making strategic decisions to maximize returns, and then some third-party vendor is voting in a way that actually does not vote in favor of maximized returns, but brings in a dilution factor, for example, ESG or DEI factors in investment, which are social goals, which may be laudable or may not. People can debate about that, but it's not what being a fiduciary is all about. And so our job was to give a report to you on really 2 layers. One is having adopted the matrix, the guidelines that you adopted last year, to what degree have the proxy advisory services follow those guidelines? Because when you're talking about 30,000 lines of code, that gets to be very complicated. So are they following the guidelines that you've instructed them to follow? The other layer of this is, and are those votes in terms of the content, not just do they implement what the guidelines say, but are those votes consistent with your intent? And part of discerning what that intent is conversations with this board and understanding of statements in the past, but also looking at legislative actions. Senate Bill 2337, for example, which is very focused on this, has made clear ESG factors and DEI factors are not viewed by the state of Texas as part of fiduciary responsibility or return. They're considered non-pecuniary, non-financial factors. So that would suggest voting in opposition to proposals which attempt to place those companies to pursue social goals as opposed to economic goals. And it would also suggest voting for proposals from other shareholders who seek to get companies back to neutral on these things. Because for many years, activist investors have been coming in here pushing companies to make, say, net zero commitments, anti-fossil fuel commitments, sustainability commitments, which maybe undermine beef production, for example, and just numerous social issues, which you're going to see, pushing companies away from that core mission. And so there's been a lot of shareholder proposals now of challenging companies to get rid of some of these recent court cases, for instance, that undermine the idea of DEI in hiring, for example. It may be illegal. Certainly, it's an illegally risky area. So we looked at those 2 areas. One, just mechanically, are the guidelines being carried out? And 2, the end result, is it in the spirit of the legislation in Texas and my understanding of this board's intent? So looking at both of those, we have a table of contents. I'm screening through here, I'm not on there, so you'll have to look through this, or someone can have an introduction on page 3. And let me just hit an important number here. PSF voting industry achieved a 99.3% alignment with the Boyer Research voting guidelines. So ISS was 99.3% accurate in carrying out the instructions of the guidelines. And we can get a little bit into more detail. In terms of absolute number, that means 2 what we call misvotes. 2 examples of misvotes, and we can talk about that. Let me just stay with the document for now and look at the highlights. So these are the examples of categories of proposals that you voted against. And it is, just to be clear, you're voting. ISS is not voting. They might be mechanically executing the vote, but the fiduciary entity is always the voter and cannot free themselves of that fiduciary obligation by using an outside party. And that's why it is so admirable that the Permanent School Fund of Texas has given so much more than we've seen in the industry in taking that responsibility, not hiding behind, well, the proxy advisor said such and such. You're taking responsibility. I just want to tell you that it's very unusual. So against poor performance in ESG at the management level. So for example, severely underperforming companies. What's underperforming mean? Not on social goals, shareholder returns. If the company is one standard deviation below the mean or first or second worst in class in its peer group, then you're voting against that board of directors. If it's a 5-year test, so they have time to kind of wide things out. At that point, you're kind of in no excuses mode. We need some new blood here. We need some kind of a no confidence vote for severe underperformance. Also in situations where the CEO compensation plan dilutes the goals of the CEO and other executives away from exclusive focus on financial performance and towards ESG or DEI goals. It basically, if you're telling the CEO, you don't serve one master returns, you serve 1, 2, 3, 4, 5 masters, social goals. You voted against comp plans that diluted in that fashion. Another example would be you voted against anti-fossil fuel activism, extremely active shareholder activist community that opposes fossil fuels. They're imposing net zero engagements. They're imposing all sorts of investment approaches. They found numerous ways. Every year there's 4 or 5 new kinds of ways they try to do this, and they change up and throw curveballs. You have been voting against anti-fossil fuel activism, which seems which is dependent on royalties. We also noticed a trend, even though there's a lot of kind of anti-energy, anti-fossil fuel engagement, that group has shifted a little bit more towards agriculture. So, the oil wells were the problem and the rigs were the problem, and now it's the cows. It's cattle that are the problem. And so there's been an astonishing rise in activism that's kind of focused on placing global warming, pressuring companies to place restrictions on farmers and mandates on farmers in the name of fighting global warming, which actually micromanage the farmers and increase costs. It doesn't seem to be in the interest of the shareholder. There's a great deal of pro-abortion activism. What does that usually take the form of? Pressuring companies to divest from states that have a heartbeat. Texas has a heartbeat bill. I don't think you want to be voting to tell companies to divest from your own state, and you aren't. There's also a lot of anti-Israel activism that's coming forward in reaction to the Gaza war. You are opposing activists' attempt to get companies to take political stances and say, cut off Israel's access to technology. If Israel's a good customer, they sell information technology to Israel. Activists are saying the companies should stop doing it. You oppose that activism. So that's what you were against. What were you for? You told companies, if you've made these decarbonization commitments in the past, anti-fossil fuel commitments, could you look at those again? And did you tell us what the actual financial argument is for that? If you're an oil company and you've made a commitment to stop emitting carbon dioxide, can you just run the data on that? What is the cost of that? If you stop being an oil company, what would be the financial effect of that? If you didn't emit any carbon, what would be the financial effect? You have voted in favor of those proposals from shareholders saying to these companies, did you get a little too far over your skis on this? And can we see some genuine economic and financial analysis? And if not, then reconsider these anti-fossil fuel commitments. And I've given is another example of those. There's also been some very fruitful engagement about online sexual exploitation. Now, that might sound like a social cause, and it certainly does have a social cause element, but it is extremely risky for companies to expose minors to sexually explicit material. And so, for instance, there was a proposal with Apple that found out that Apple turned off the porn blockers in direct messaging for children when they turned 14 years old. And then they could just receive those images in direct messaging. Seemed risky. And to that effect, the proposal did well, partly because of voting entities like you, to say to Apple, is this not a risky thing? I just want to be clear. This is not a moralizing point. This is a risk point. Apple said, you know, you're right. And they turned on those protections again. They made that announcement. So this voting actually can change things in corporate America. We think that's good for Apple in terms of and also non-discrimination in charitable giving. A number of companies will match charitable gifts to their employees make, except to churches and synagogues. Won't match to religious institutions or ministries. It seems discriminatory. There's no business reason for that, or at least none we can find. These proposals have asked the companies, is there a business reason for this? And if not, would you consider it? So we voted in favor of this, asking companies not to engage in what on the surface seems to be discriminatory activity, in this case, religious discrimination. We just had a highlight here. A lot of the industry is focused on when do you vote with management or when do you vote against. We don't find that to be the most helpful thing. We find the most helpful thing to be how do you vote? What is your philosophy? So that means that sometimes you can have anti-fiduciary activity from the management teams of the companies. They might have made commitments that they shouldn't have, or that they have. So we've already mentioned underperforming boards, compensation plans with ESG inducements. You're challenging companies with your voting on this. Climate transition plans that they have not provided any rigorous economic analysis in favor of. Things like golden parachutes. If the CEO underperforms, someone takes over the company, fires the CEO walks away with a huge payday. You're voting against those sorts of things. And I think we've kind of hit a lot of the highlights here. So let me just kind of go back to that. What does that 99.3% fidelity means? It means in two cases, there were proposals from pro-fossil fuel activists, which were asking companies to reconsider their net zero commitments. We were a yes recommend on that, and ISS in those two cases voted against. We don't know why. We're going to engage. So what do you benchmark that against? 100%? Well, you always want 100%, but benchmark in terms of realistic, that is an extremely high degree of fidelity. ISS carried out a high degree of accuracy of the guidelines, and we believe that those guidelines represent that Senate Bill 2337 point of view, and the point of view that I've been instructed by this focus on shareholder returns and not dilution with ESG or DEI social goals. I'll see if there are any questions.
Give us a little more color around the two votes and everything.
Yes, there were two votes with energy companies, with an activist group, New Breeze, and these companies had made net zero commitments. And these proposals were asking them to reconsider those net zero. Now, with proposals, they're always a little complicated. They do more than one thing. And there were some elements of those proposals that I can see might have been of concern, and maybe that's why the misvote occurred. So to say to a company, you have these net zero goals, can you tell us why you think they're good for shareholders and why they might not be? That seems very agreeable, but it also asks the company to reveal what their litigation or legal liabilities might be for that. From a fiduciary standpoint, there is a question about whether you want companies to be testing things, abilities which then can be exploited. So in that particular case, I can understand why the misvote occurred. And there are a lot of edge cases. You can make a case for or against. We would have been for. It was an energy company. They shouldn't be making net zero. And they could have come back and said, well, we're not going to give you anything that will help litigators against us. That also seemed like a good idea. The other was, again, another energy company. And the argument, again, was if you made a net zero commitment, how is that good for shareholders since you're an energy company? But they also added what we considered sort of a political argument, which is fossil fuels are good for the country. Therefore, you should continue to do this. Now, I believe the fossil fuels are good for the company. Probably a lot of people in this room believe the fossil for the country are. But that's not our aperture. Our aperture is, are they good for the company? Right? Because that's your role as a shareholder. You're not another actor. You're not CalPERS of Texas. You're not an activist fund. And so focusing then on the company terms, whether fossil fuels are bad socially is not really the main point. Are they profitable? Well, yes. to get out of them by 2030. By any time period, seems to be kind of short-sighted. By the way, none of them ever look at the question, should they aim to have more carbon emissions? The conversation is, how quickly do you get your carbon emissions down to zero? When actually the data suggests that for these companies, carbon emissions positively correlate with profit. So that's a conversation that maybe would be had with these companies. In end, to being fossil fuel companies, rather than to always be negotiating with people who really don't think their business is. So I hope you'll forget that.
All right, questions? Questions for Mr. Boyer? Just give you a question.
Thank you, Mr. Chairman. Jerry, thanks again for your work on this. It's something that several of us on the board worked on for a number of years. So appreciate the work you've done for a second year here for us and for the out brief afterwards. I want to ask a quick question. So let's just assume for a second that the Boyer research guidelines are 100% what we need to do as a fund. What would be the difference in votes between what we did and approximately what we would have been on with the last plan that we were on? Does that make sense?
Yeah, it does. I mean, you're comparing to the counterfactual, like what you were doing before, and there were different phases of what you were doing before. At some point, more standard proxy advisory service. So that would have been a much lower fidelity in terms of the objectives. Then you switch to essentially abstaining on almost all of those proposals. And you know, that's an understandable strategy given how opaque the system is. The system is opaque. It's hard to know what's going on. Often proposals are written in a misleading way. So to say, I don't know, is understandable. But to me, the gold standard would be to actually have positions on these issues, especially when there's a sensitive. So it's hard to know how to count an abstain. So if you abstain on something that probably would have been good to vote for, or you abstain on something that probably would have been good to vote against, how do you count that? And I'll just use the citizenship standard. You know, people vote in elections. Sometimes they don't vote on things they don't know the answer to, judge retentions and not be sure, or which county commissioner they favor. The ideal would be to know and to vote. And I would say you are in the knowing and voting strategy, having been in the not sure about all these. Safest course of action is to not have an opinion. So I would say in terms of fidelity, like when the abstentions, kind of counting an abstention is sort of like a 50% wrong or 50% right, not a 0 or 1. I would say you're in the, that would have been maybe 60% before in this analysis, as opposed to 99.3%.
Okay, thank you.
Anybody else? No? I think this land office should be pleased with this. Yeah.
Impressed.
Well, very good. So, all right. Well, with that, Jerry, good work.
Thank you, sir.
And thank you for that. And we, I think we just need to get a few more Texas funds on board with that. We're working on it, right?
We are.
We're
You're leading again.
we're leading.
And you were first over the wall. Now there's 6 states that are doing this. Your neighbor to the north, Oklahoma, just voted to do this.
So, thank you for that. We're going to move on to our report from the general fund consultant. Red Humphreys is suffering in 85-degree weather in Puerto Rico, and with a climate there, and so he sent a fill-in whose name is Phil, and so Philip Nelson, welcome aboard, and I guess you're going to fill us in.
Yes, thank you.
Yeah.
So thanks for having us, and also have Keith here with us, so I think you've all worked with in the past as well.
We're in North Carolina.
And just as a, maybe just kind of quick quick reminder, our role as part of it is providing asset allocation advice, working on strategic asset allocation issues that come up. So things along the lines of capital market assumptions, risk assumptions. I won't get into it because Rhett would prefer to edit me so I don't talk an hour about correlation assumption. Usually can. If you have questions, feel free.
I'll stop.
Yeah, you'll stop. Thank you, Stu. So a lot of some of the underlying risk inputs that feed into some of the asset allocation analysis that's ongoing here. So that's part of my role at NEPC. Also part of that is setting our market outlook for the year. So have a little bit of a preview for all in terms of some of the things we're thinking about, some of the things we're talking with our clients about in terms of asset allocation themes that are coming up. Try not to flip through every single slide here, and if you have questions anytime, feel free to fire away. But I think a couple of high-level points we want to address that we're hearing from our clients, we want to be proactive about in some ways. I think first the question that comes up often is, are we in an equity bubble? And in our minds, simply, there's a lot of different factors we can look to. Often it can compare to the U.S. markets in the late 90s. How do we compare that? In our view, valuation levels aren't where they were in the late 90s. Earnings profile is very different. So if you look at the gains of many of the largest tech names in the US over the course of this year, much of that gain has been driven entirely by earnings growth. Very little of that has been driven by kind of PE or valuation expansion. So again, those are things you typically wouldn't see in a bubble. And I think also you may see this, the sentiment for the market environment is different. I can't recall a market bubble or a market exuberance where people have been so frustrated with the market going up. And you think about since April, we had tariff announcements, market sold off, rebound since. You still see this kind of lingering frustration with markets. So we're up 40, 50% plus those levels. People aren't really very happy with it. And you need to have kind of real irrational exuberance during a market bubble. And you have those anecdotal events you see throughout the day. I can remember back in 2007, my old prior company had come down to the accounting floor and asked for something to be produced. And they go, well, we need a couple extra days because everyone was either taking the realtor exam and or showing houses. And I lived in Arizona. So that's the type of thing, you don't see that today. You don't see that level of someone's like, I'm gonna go start a data center. Like that's not an individual response you see in terms of kind of real market bubbles. You see some of that in the crypto space, but when we get to kind of US equity markets, not something we're concerned about. In terms of things that aren't coming up a lot, 2 years ago, inflation was top of mind. Currently, I can't think of the last time I got a question on inflation. And I would say we're not concerned about inflation, but what are the things that could surprise or shift how the market's pricing current fundamentals? And inflation would be the one that would be a surprise. So as we start this next year, we have probably higher M&A activity, better regulatory backdrop. We have bank lending structures starting to open up. So some of the capital requirements for the banking sector have been easing. The last quarter or so, we've seen bank mergers. I can't remember the last time we saw actual real bank mergers. It wasn't forced by the FDIC. And on top of that, we're entering a rate cutting cycle. So you have all of these tailwinds. In addition, and I think there's a long list, in addition, you have a lot of the tax provisions and spending provisions that were announced this last summer will kick in January 1. So accelerated depreciation for companies in terms of their spending. So there's a real big stimulative flow that's going to be coming through the US economy this coming year. And to the extent that you don't have big disruptions in the labor market, get a little overheated of inflation should we see that. And I think that's one of the things that throwing it out there just to keep in the back of our minds. Some of that is maybe a little more comfortable with public real assets or real assets in the current market environment. That's something we've been chatting with our clients as well. The other is the Fed. We have a Fed meeting next week. Likely we'll see a rate cut. We don't want to be in the business of predicting the next meeting what the Fed's gonna do. If the Fed cuts next week, which they likely will, so be it. If they don't cut next week, that cut just gets pushed to 2026. Nevertheless, we're clearly in a rate cutting cycle. There's a bias from the current Fed FOMC members to push rates lower. With a new Fed chairman coming on May of 2026, that bias is likely to continue. And I think the piece that we are thinking about is by end of 2026, if we see Fed funds in a 3.25, 3.5% range, that's probably okay, as long as inflation is not rising too much. I think where we would get concerned, where we think the market may react adversely, if you see the Fed push Fed funds below 3% too quickly. When I say below 3%, where we get to a 275 number and you still have unemployment in the fours, you still have positive consumer spending, you have a healthy capital markets. That's maybe a little too quickly, a little too much. Back end of yield curve, bond market may start to react to wonder, is the Fed managing both mandates, both inflation and labor? So again, a little bit of a tail risk out there. The last piece to mention, question we've got throughout the year, is on the US dollar. And I think you can see the headline here, don't fear the US dollar. Some of that is driven by, there's been a lot of discussion of, dollars down 10, 15% over the last year. Is that because there's a fear that the dollar is losing its global reserve currency status? Are people fleeing from the US dollar, especially overseas, for geopolitical reasons? And in our view, the answer is no. When you look at kind of the dollar's valuation profile 12 months ago, it was an overvalued status. It, based on several different models that we have, others out there, dollars in overvalued territory. The start of the year, a lot of investors outside the US, especially European investors, were overweight dollar, overweight equities, and they pulled that back start of the year. Think of it as a simple rebalancing flow. And some of the market turmoil we saw in April, I think a lot of viewed kind of the lack of movement in treasuries, the lack of rallying in the dollar as a signal maybe there's something wrong with US markets. We took a different view. We think of it as just there's a deleveraging event that occurred, and two of the more overweight positions were reduced. Recently, this last couple of months, we've had a couple pieces here and there where little wiggles of market concern. You've seen treasuries respond, you've seen the dollar respond. So in our minds, US dollar is still 90% of trade in the world is traded through US dollar in some form. And I think I would view the US dollar differently than gold. So often those get paired together. Gold right now is off its own fun adventure where, for decades, gold really didn't do very much. You look at an inflation adjusted level, gold prices are more similar today than to where they were the late 70s, early 80s. Again, not necessarily an inflation call, but there was a response to gold that's happening out there from markets. And there's two ways you can view it. One, you can say, okay, the market's fearing instability, fearing inflation, gold is rallying. I think the second way to view it, which I think is the more likely, is there is a great deal of gold purchases coming from central banks around the world. These are price agnostic organizations. They want to build up gold reserves because they want to have flexibility in case of any risk of US sanctions. So there's a little bit of not a dollar selling from some of the central banks, but whether it's China or Russia doing it in some form behind the scenes, there is a wide swath of gold purchases that are occurring more for geopolitical reasons, and I would argue for what's called macroeconomic fundamentals. So that's the kind of high level backdrop. Why don't we jump?
Yeah, I mean, on the inflation part, so you and your team, think about it, fleshed out, we're, I guess, a year and a half away from 8 or 9% inflation. We've settled in at 2.5, 3. What would spook the markets, right? We have fiscal stimulus coming in, we have monetary stimulus coming in. Fed cuts, is it a year-over-year 3.5, 4, or are we right? It seems like we're comfortable in 2.5 to 3% range, which is not the 2% Fed target, but what?
Yeah,
what do you think spooks
I
the
don't think
market?
it's an absolute level of we have 4 to 5. It's the rate of change. And you can see kind of rolling 6-month basis, inflation is slowing to some degree. Now you could argue some of that slowing is occurring as we have likely some sort of manufacturing recession in the US. If you strip out construction spending in the US, you strip data center spending from that, it's relatively weak. And so what's called the old economy in the US is suffering from recessionary-like conditions. So if that comes back online in a quicker way, and you see the trend rate of inflation start to pick up, I think you'll see the market repricing inflation expectations. That's okay as long as the economy is growing on a nominal basis. I think what is more the concern is, and I don't think this will happen, not our base case, but could you see the Fed cutting rates in the back end of 2026, despite the evidence of maybe inflation ticking up a little bit? And I think that is the calculus that you see a little bit of concern in the back end of the yield curve. Why don't we jump 2 slides ahead here? Just want to talk a little bit about S&P 500. I don't like saying the word Mag 7, so I just say top 10. Same difference. But, we've been looking at, for 4 or 5 years now, different ways to diversify S&P 500 exposure. In some of our portfolios that we manage for our clients, it sounds like we were even earlier than you all in terms of diversifying some of that S&P exposure. But we were concerned and are concerned about, the concentration that exists in the top end of the S&P 500. And I think there's 2 ways to look at it. We're using S&P equal weight as a measure, comparing performance of that to S&P 500. This is on a rolling 3-year basis. And you can see top end of S&P significantly outperforming equal weight S&P. Now, a lot of different ways to look at this. Is this a bubblish sign? The top 10 names are overpriced, sentiment's heavy, driving up market cap levels for these names? Or on the other side of it, is this a rational economic action? Do you have a select number of companies that in some cases are bigger than countries that are run and managing in an industry where they essentially have monopolies or oligopoly-like practices? So when you think about, Google, Amazon, NVIDIA, names of that sort, they are run in a cartel-like way where they are sharing their product with another company sharing their product. So it's all an integrated system. 30, 40 years ago, you might have broken these companies up and there would be 60 companies participating in this. Now there's 5 or 6. And so until we see some sort of shift in terms of the regulatory backdrop, or there's a new competitor that comes on, or there's a new technology that comes on, I think it's tough to see what breaks down some of the control that the top 10 names have in the market, which is really tough because when you think about from a mean reversion standpoint, should we expect equal weight S&P, or kind of as we look at it, kind of value and quality factors that exist in US markets around the world start to do better on a relative basis? And mean reversion needs a catalyst. And until we have that, this trend may continue for a bit. I'm going to make you jump around because we're going to go, I think it's to the second to last slide I have.
That concentration does constitute tension.
It does. And it becomes, what is your risk tolerance? And some of it's a tracking error tolerance of, if you're benchmarked to S&P 5, how much tracking error are you willing to take by underweighting those top 10 names? If we go to slide 9, or 1 slide back. Thank you for reference. This is expected net income growth for 2026 for S&P 500. 7 names constitute over 50% of expected net income growth for the S&P next year. NVIDIA accounts for 22%. So to some degree, it's 7 names, but really it's 1. And so this is where it's a tracking error tolerance. There has to be a red line, I think, for most investors, where if we see 7 names that are 50% of the index, that gets a little too much. But I think one of the thought exercises that we've gone through is if we had a very large private equity fund and we had a bunch of winners that were outsized and running, would we sell them on the secondary market? Even if they got to such a large percentage of our portfolio that they were our biggest positions in the portfolio, throwing off tremendous earnings growth, we would probably have a little more tolerance to let the winners run. And I think that is the calculus that we're constantly battling. What's the tracking risk that we're willing to tolerate? What's the concentration risk that we're willing to tolerate? And we have red lines on both of those. And I think each organization is important to set what those are. But then also, long-term, and at the end of the day, long-term, you want to build wealth. The best way to do that is through corporate earnings growth. But we want to be hoarding earnings growth. And these are the names that are providing it. And if the valuation levels are not so far out of whack, there's a reason why they're expensive. So there is some positive constructive view that we have on this. Of it's tough to underweight them too much, I think is the. And I think there's a couple different ways to think about how do you diversify from those large names. You go one slide forward, please. This is looking at forward PE multiples for various segments of the market. So obviously Russell 1000 growth, heavily weighted to many of the tech names. High end of a PE multiple, also because growing heavily. When you look across the board, you look at mid-cap stocks, which is Russell 2500, large value stocks, Russell 1000 value. You've got equal weight. You've got developed market stocks in Europe, Asia. Are all trading at roughly similar valuation levels on next year's earnings growth. So one of the things, again, that we've kind of thought about as kind of a thought exercise, and Bob, you kind of alluded to this earlier, is if we set our portfolio and just held the top 10 names around the world, so you're holding the NVIDIAs, you're holding the Amazons, Microsofts of the world, along with the Taiwan semiconductors that are benefiting from this AI secular growth shift, and we set our tracking our budget of how much we wanted to hold, and then the rest of the portfolio, we're just looking at active names across the board of where are good value companies, where are good quality companies, and everything looks pretty similar, And so you get into the calculus of, would I rather own a bank in the U.S. or a bank in Europe? Is a materials company in Japan, a materials company in Europe, or the U.S. or North America? What are they trading on an individual basis? What's their individual cash flow profile? So there's a bigger emphasis on the line of looking for good quality companies around the world from an active management lens. So setting your risk budget based on some key factors, and some of that really is going to be size, is going to be the most important factor. Because that's where a lot of the tracking is getting driven these days.
Phil, do you happen to know off the top of your head what the forward PE is on those top 10 companies?
It's changed a lot this last month. I just looked at NVIDIA yesterday, and forward NVIDIA was about 26. So it's not, this is the problem. It's not bad. And I think there's a labeling at play. There's a labeling mechanism at play where you hear in the financial news, these companies are overvalued. There are some companies that are trading at 100 times PE multiples or trading on price to sales levels like we saw in the late 90s. Those seem very excessive. But if I'm looking at a company that's growing 40% sales, it's got 70% gross margins, it's a good business. And how much risk am I willing to take on being underweight to that? I think that's constant battle that we have. At the end of the day, my role is in an asset allocation function. And when the risk budget becomes too great from a small concentration, we're going to hit a button to say it's time to rebalance or time to readjust. And I think part of that is thinking back to, the goal is not to own the top 10 names. The goal is not to have S&P outperform all the time. The goal is to meet your investment objective. And I think that's what we're trying to do with all our clients, reminding them, here's your return target, here's your goals, here's your needs. Can you do that without the top 10 names? And if that's the case, finding a more diversified path is at times maybe an optimal long-term goal. Much more than that. Maybe if we go one slide forward, it's kind of some high-level thoughts that we're sharing with the clients. You heard much of this already. I think overall thinking about really embracing diversification. We don't want it to be naive diversification, where we're just adding things for a correlation benefit. But I kind of use the example of, how do we diversify away our equity exposure? Can we look for quality companies, value companies that are trading at reasonable multiples around the world? Are there different ways that we can obtain those companies that are doing well? I think second is being a liquidity provider. We've seen over the last 3 or 4 months some little hiccups in the credit markets. Maybe they're all idiosyncratic, maybe they're not. If you're in a position to be a liquidity provider, which certainly seems like you are, there's opportunities to take advantage of things that are going to be coming in the next 18 months, we think. And so there's a strong bias to kind of really maintain liquidity to be able to do things quickly if need be. I think third is just the importance of alpha. I say this from an asset allocation lens. I deal mostly in the beta space. I will be less busy this next year because asset allocation, passive beta structures, I think will be less important. I think putting more of risk budgets into active risk, active management, whether it's public or private, I think is important, especially in a world where everything's a little overvalued. Is if you look at US close to all-time highs in their stock market. Same thing in the UK, Germany, Japan. It exists all around the world. So finding an active management lever you can pull, I think is really, really important. Obviously equity exposures are really important. I think overall, we have a little bit of a bias to equity markets today relative to credit markets. It's not that we see credit issues or leverage issues or concerns in any way about the banking or financing structures around the world, but spreads are relatively tight, relatively kind of healthy sentiment level. And I think all things considered, credit investors, we like to put money to work when everyone's feeling miserable. And if everyone's feeling too good, it's a good time to shy away from credit a little bit. And I think the last piece, not that Bob's section of the presentation is boring, but I think it's important us to be boring in terms of our outlook. Focus on strategic objectives, focus on liquidity profile. Don't try to stretch for returns, especially in this type of market environment. And I think patience over the next couple of years will bear itself. So at high level, how we're thinking and talking with clients. Happy to answer any questions that come up.
All right, questions for Mr. Nelson? Thanks for coming.
Yeah.
And thanks for joining us today. All right. We do have a review of our real assets and real estate, the asset class. Nick, are you up?
I'm up. Melissa, do you want to pass out so we have hard copies because I think there's a couple pages that are redacted. So if you flip along on the screen, there will be some redacted pages. Melissa is passing out hard copy. And then for those of you that are looking at the presentation diligent, you can follow on beginning on page 63 and diligent. So I'll just let you get those presentations. And then we'll start. Okay. For those of you that don't know me, my name is Nick Tramontana. Next month will be my 13th year anniversary here. Really pleased and honored to present on the real estate and real asset program. I hope as we go through it, you find it both transparent and informative. So turning to page 3, just to discuss the role of the real estate real asset program. It is to generate returns from tangible assets or asset-heavy businesses. The program is supposed to have less correlation to other investment asset classes. The program is supposed to deliver income and appreciation, and in many cases, provide a hedge against inflation. And just looking at the photos on the left, these are all just stock photos, but just from top to bottom, an office building, a gas-fired power plant, a data center, and everybody in this audience knows the last one, oil and gas. So just some examples. So the program has 11.6 billion of net asset value across 4 discrete portfolios as of the second quarter of 2005. I have a deeper part of this presentation, more detail on each of these 4 discrete portfolios, but we have 2 in real estate, a core real estate portfolio, a discrete non-core real estate portfolio, and then when in real assets, we have infrastructure and natural resources. And I will get into those in more detail in the presentation. But as you can see, they all have varied target returns and varied risk profiles. You can also see the net asset value of each individual portfolio. And I think what I would say to you, looking across the bottom, is that these are all portfolios that are mature and are pretty much near or at their long-term allocation target. In fact, if you sum across the 4 portfolios, they have a target allocation of 22%, and we are currently at 20 of that 22%. The other thing I think is important, just because Bob brought it up, no investment in this portfolio is a fund-to-fund having any double layers of promotes or fees. So this portfolio is all us investing in private funds or co-investments without any of those double layer fees that were discussed before, maybe in some other asset classes. Turning to the next page, just a high-level overview of performance. So let me just walk you through that. One, we're looking at these on different trailing time periods. So you can see this over the shorter term 1 year all the way out to the longer term 10-year. And then the dark numbers is our portfolio's performance on an absolute basis. The dark navy blue bar is the benchmark performance. And then the orange is our actual relative performance, which, fortunately from this page, you can see of the kind of 16 data points, I guess, there's only one period where we're actually underperforming versus our benchmark. So very pleased to show you that. And as you can see, there's some combined excess return shown at the top, but I'll get into these portfolios in more detail and talk a little bit more about attribution as well. Going to page 6, this is just another graphical representation of what you just saw. This is all how are we outperforming and by what for each of the trailing time periods and by each discrete portfolio. Going to the next slide. So I'm looking forward to introducing you to the team when I go through each program, but I think what I want to impress upon the board is that we very much actively manage this portfolio. First, I think everybody knows that in 2023, when we formed the corporation, the real estate and real assets program of the Texas General Land Office, their investment partnerships were actually ported over to the corporation. That was over 6.7 billion of real estate partnerships and real asset partnerships and investment manager relationships. And that was no insignificant undertaking. We spent a lot of time trying to understand each of these partnerships owns a lot of investments, and we put together a database to make sure we really understand what we own in real estate when this came over. How much do we own in office? How much do we own in California, overseas? Same thing in real assets. How much, oil and gas now do we own in the Permian versus other basins in the U.S.? So this was a huge undertaking by us, and obviously I'm also, establishing relationships with these GLO managers, and that's gone on seamlessly. The next thing, just in terms of active management, is in the last 18 months, we have committed 3.5 billion to these portfolios across 23 funds and 9 co-investments. And what I would say, I think when I presented to you all in April of 24, I think we talked about the number of meetings it takes, the number of screening, repeat meetings. So to get to what we did is a huge effort in terms of work. And I think Bob had something on there with kind of the filter of what we do to find these things. Co-investments, as you know, Bob mentioned in the strategic plan, that's very important to us. Generally, most of these are fee-free, carry-free. They require a lot of kind of, being able to react quickly. We have a great investment committee process and team set up to do that. And I do know that some of these commitments were Texas managed. Wrapping up for this kind of high-level overview is just kind of outlook and positioning. I will get into each of these asset classes in more detail, but I would just say in terms of outlook, there is definitely more positive news than there is negative news. So just net, I think there's a lot of good news coming for each of these, but for different reasons. And I'll go into how we're going to be positioning the portfolio in more detail as I go through it. So first, I'll get into the real estate program, and I'll introduce the team. Just about myself, I did say I've been here for going on 13 years, starting in January. Prior to that, and for most of my time here, most of you know, up until 2024, 100% real estate. So have really drank by the fire hose over the last 2 years, and have really enjoyed the expansion into infrastructure and natural resources. But my background before joining here in 2013, I was down the street at the Employees Retirement System of Texas, where I helped them launch their private real estate program in 2009. Before that, I was with a publicly traded home builder on the New York Stock Exchange, where I did direct deals, M&A for acquisitions and mergers with that company. And before that, I did investment banking in New York. Just quickly about the team, they're all downstairs and probably listening in. We've got Will Albright, who joined us from San Antonio Police and Fire and has been with us for almost 10 years now. Herman Oteza Sepulveda, he was a reference from one of our partners in Boston that teaches at Harvard Business School, and happy to have Herman, who's been with us for over 3 years now, and has also a master's in science from SMU and a prior background in real estate development and construction. Dan Hires, been with us for almost 7 years. He's an NEPC alum out of Boston, and happy to have him on the team. Vlad Ivanov is a senior investment analyst from the University of Arkansas in the finance program. He's been with us for 3 years. And then Abby on the far right, I think she may be the first quote unquote graduate of our successful internships program that Bob mentioned. She is completing her final year at the Macomb School at the University of Texas, but she is interning 3 days a week for us, both in the fall and the spring. And so that program has just been an absolute home run for us. All right, I'll go to the portfolio 1 out of 4, and that's core real estate. So if you go to page 12, I'll just kind of mention what core real estate is. So core real estate is a classification in real estate that is really for the lower risk returning portion of real estate, meaning these are typically more like fully occupied buildings that are throwing off cash flow from leases. I like to equate it with thinking of it like a dividend stock. You're going to get most of your return, if you look at the bottom, from income, but you do have the optionality of making some on appreciation as well. Typically over time, the long-term kind of return net of fees is around 6 to 8%. So going to the next page, I think most people know that real estate has gone through a very material price correction. You can see on the far right that since the 2022 peak, prices are down almost 17% across the board. It's not uniform. Some property types, such as office, have underperformed more than others. But what you can also see on the far left and middle slides is that we are showing signs of having turned the corner on that. Next slide. This is how the core portfolio is performing. Again, the dark numbers are absolute performance. The orange numbers is our relative performance. Pleased to report that across 3 of the 4 time periods where we are outperforming. You can see on an absolute basis, I mentioned the downturn in 2022, and so those 3-year numbers on an absolute basis are down. We still are outperforming in that time period. On the 1 year, we are underperforming, and I have a slide that will discuss a little bit of the attribution of that. The next slide here is giving some, shedding some kind of information on just how our core portfolio looks from a composition basis of underlying property type exposure versus the benchmark. And we really believe that the reason you saw 3, 5, and 10-year outperformance in our portfolio is our property sector allocation. We overweighted to the industrial property type, the warehouse property type. This has actually come down from probably almost 50% a couple of years ago. And that was a good sector decision on our part. Industrial warehouses really benefited over the past decade as e-commerce grew. And so landlords of these warehouses have really been able to push rents at above average rates relative to other property types. So very fortunate on that, we had that sector weighting through our fund manager selection. Going to the next slide, I pointed out that we are underperforming on this portfolio on a 1 year basis. We had 11 of 12 quarters of outperformance versus our benchmark, but beginning in the first quarter of 2024, we started outperforming in 5 of the last 6 quarters. What I can say is that in 2022, we looked at a lot of our holdings, and many of the funds in which we're invested in this portfolio are actually unique. They're called open-end funds, where you can submit redemptions on a quarterly basis. So if you want to take some wins off the table or do some rebalancing, you can do so. So we decided in 2022 and 2023, we wanted to take down some of our winners. That was really these industrial funds. I mentioned we were, I think, up over 50% allocated at one point. We're now down into the 40s. We also looked at some of our funds and said, we think probably we should redeem partially or fully from some of these, as we think maybe the compositions of what they own, maybe office in certain markets, or their valuations might just look a little high going into this period. We might want to submit some redemption requests from them as well. And really what happened is our winners redeemed us pretty quickly, but the ones that we were concerned might underperform have been slower to redeem. Many of you might see that to get liquidity back from these things is taking longer than we expected. And so the winners redeemed faster, the underperformers redeemed slower. What we've done on an active management side, we are in constant engagement with those partners about when we think those redemptions will happen. And also we've kind of offset that with some commitments we've made on our end that we think will counteract some of those concerns. Just going to the next page, just market outlook. All I want to explain to you is that I think we are cautiously optimistic that if this was a U-shaped recovery, that we might be at the inflection point of the U-shape. NEPC was talking about the rate cutting cycle, and that's the upper left part of the charts there. To the right, there's just some fair value indicators. See how do private real estate look versus publicly traded real estate investment trusts? How do they look against BAA corporate bonds? And they are really screening to be kind of at the neutral point. The lower left, new supply has really come down in the last 2 years. There hasn't been a shovel put in the ground for much new development, which is going to create some really strong fundamentals. And all that is leading to some really positive headlines. I think the Wall Street Journal this week had an article that said commercial real estate is almost too cheap to ignore now. So cautiously optimistic that we are turning a corner, but it has been a sanguine 2 years, to say the least, in the private real estate sector. And I will just go to the next page and just mention to you that we have been active, not just redeeming, but making investments in the core real estate space. And probably use this adage too much, but with respect to this portfolio, we really are trying always to skate to where the puck is going. Hence why we really overweighted to the industrial warehouse property type several years back. And what we've done in the past 18 months is we have made a commitment in 2024. We think at very low valuations, hopefully trough valuations, into apartment only fund that will get our weighting up from neutral to maybe slightly overweight. We do like the rental housing and demographic driven sectors quite a bit. And then we made a commitment to a fund that specializes in what in the industry is known as alternative property types. And the four here, medical office, senior housing, student housing, self-storage, those are just like four of, probably 14, 15 of these alternative property types. Our benchmark last year actually expanded to include more of these property types. So we really wanted to kind of get in front of this. We think a lot of these funds that comprise a benchmark will be investing more in these spaces. So we pulled the trigger on committing to a fund that would get us exposure to these property types, and think in the coming years we'll like the allocation we have. All right, I'll switch to portfolio number 2 in real estate, which is non-core, and you can just switch to page 20, and I can describe to you what that is. And really, non-core is just a higher risk return categorization for something that isn't core. So these are things that have a little bit more hair on it. Maybe it's vacancy, maybe it's repositioning, putting a little bit of CapEx to spruce something up, but it has a higher risk return as a result, usually a little bit more leverage to it. You can go all the way to the furthest end of the kind of risk spectrum and think of development. And as a result, you need a return that is commensurate with the risk you take. Generally speaking, after fees, you're thinking more like 12%. And I mean, if you went as far as looking for a development and construction strategy, it's significantly higher, usually north of 20% net of fees. And probably intuitively, as you can look at the bottom of the page, most of that return is going to come from appreciation as opposed to income. So turning to the next page, happy to report that performance on a relative basis, if you look at the orange boxes, have outperformed the benchmark across all 4 time periods. You will note, just like I showed you before, on the absolute basis, when you incorporate the 2022 price correction, absolute performance is negative. The next page similarly just goes through the composition of the portfolio's property sectors versus the benchmark. It's always hard to have too much attribution look through by property type. For example, we really love demographic driven sectors. You can see, for example, that we have an overweight to residential. We like those sectors. We think from a structural standpoint, they're going to be quite resilient over the long term as home ownership is not affordable. And we also like the senior housing space given the aging demographic. But that was a challenge space during COVID. So, but generally speaking, you can see we do look through at our sector allocations in this portfolio as well. Just turning to geography, the non-core space is unlike core that I went over, which is 100% U.S. This portfolio is global. You can see the benchmark is global, and we're really tracking very closely to that index, and have continued to think that the opportunities make sense to stay close to the benchmark. The next page is we're going to consistently talk in every portfolio about active management, and given where we've been over the past couple of years, I would say most everything has been tactical in nature. So, but I will say, Bob mentioned strategic partnerships and leveraging more out of fewer partners. When we got when we inherited the GLO portfolio, we inherited, more managers, more partnerships, and we had to really look at do we have any overlaps? Are the same people, buying apartments throughout the Sun Belt region of the U.S.? And so we're really cognizant. And last year we re-up with one partner that is high conviction, that has a diversified U.S. strategy. That may come at the expense of some other partners that we're really going to try to leverage to have fewer and larger relations. And also that does help co-investment deal flow as well. Next, just there is a theme. I think we remain tactical, but in this portfolio we like demographic driven real estate as opposed to more maybe GDP driven real estate. So you can see grocery anchored retail, medical office, senior housing, all those are more demographic driven than correlated with GDP. We can't ignore what's going on secularly speaking, and we have been following the data center space. I think we made our first commitment in 2019 or 2020 to a fund that provides development, construction, equity to build data centers in the Northern Virginia kind of main and main universe. And we've expanded that this year with some partners that are doing the same thing, but in some other key data center markets. And so I'll wrap up real estate to say from a market commentary section, I think we're turning a quarter. We'll be cautious. We own stuff that, even if becomes a good time to buy, it doesn't mean some of our legacy holdings that have office or maybe parts of Europe, which has had a slower relative economy and therefore slow to rebound, or maybe some funds that bought at the peak of the market in 2021. I think we'll have to monitor those. I am cautiously optimistic about those, but for new capital to be deployed, I think we're entering an attractive cycle. All right, I'll shift gears to the real asset side. And so I told you this has been my learning curve, and I've absolutely loved learning about infrastructure and natural resources. And we quickly assembled a team here. So unlike the team I introduced you in real estate, many of whom have been at the PSF for 7 or more years, the first thing we did was get together a team. Starting at the left, we have Michael Hugh, who joined us over a year ago. He was a reference from Will Albright in the real estate team. So I think really happy that our reference program really works. Michael, if you look at his prior background, he was doing investment banking for a global infrastructure leader, Macquarie, and he really focused it on all of the parts of the energy value chain from upstream, energy to midstream to downstream refineries, and has been a terrific addition to the team from his just content and industry knowledge. Next is Jessica Johnson, who some of you may know. She came over when the PSF and the Texas General Land Office investment teams. Jessica's been terrific. She has a finance and accounting background, and she's been terrific continuity with the relationships, the investment relationships that the GLO brought over, and she had tremendous institutional knowledge. You're seeing Vlad here with a dotted line around him because when I took over the real assets program, I said, Vlad, I'm deputizing you to work on both. We needed the help, and he's been terrific. Maybe at some point, Vlad will say, I like one group or the next. And then Christian Gomez, fresh out of school a year ago, he was referred to us by some of the Texas State grads that we had that did the CFA challenge competition, and we're in the finance and accounting program. And we're contemplating adding somebody in the new year to help us manage our workload there. Okay, so I'll jump to page 29 and get into our third portfolio out of 4. This is the first of the real assets portfolio, and this is infrastructure investments. I probably by this page, go to the next page. These are kind of the essential service asset heavy businesses like utility, transportation, power, social things, and digital. I think McKinsey put out a report this year that by 2040 there's going to be 106 trillion of investment capital demand. This is really I've been quite blown away with kind of the volume and speed of and size of the capital needs that are going on because of what's happening from a secular and geopolitical standpoint. The other thing I would say about this investment asset class, just to look at the bottom of the page, when I took over, I thought of it as, oh, these are all kind of more bond-like investments. Think about toll road where you're clipping a coupon, but it really is a spectrum. It's also, equity-like as well. You really can play the infrastructure investment asset class, however you want. And we're cognizant of how much risk we're going to take on. We're not going to chase returns to be all equity like. We're also not going to be too risk off by just doing bond clipping coupon. But it is interesting in that regard. And just going to the next page, this is our private markets benchmark provider. So, real estate, non-core real estate uses this benchmark provider. Private equity uses this benchmark provider. Private credit uses this for its non-investment grade. And I think it's really been amazing over the past decade. Infrastructure, we just highlighted for you. It's been, quite consistent. It's had a pretty attractive band of top and bottom returns. I mean, its worst performance here, I think 2024, 6. I mean, contrast with the real estate or natural resources, some years it's 20% and other years maybe negative. This is a really interesting aspect. That has a lot to do with the types of investments you get. They usually structurally in the takeout contracts and other things are they have some caps and sometimes linked to inflation adjustments. So that is really something that we find attractive about this asset class. Turning to the next page, I mentioned that, when we took over these portfolios, first thing we did is that we want to know what we own. And then the second thing is the board, I think it was at the February 2024 board meeting, adopted a new, more relevant benchmark for both real assets portfolios. When they were at the Texas General Land Office, the performance benchmark was more of a consumer price index based benchmark, and many institutions adopt that, as NEPC would tell you, for these types of programs. But we shifted, and the board agreed to change it to the same benchmark provider as all of our other private market classes like private equity, private real estate, private credit, MSCI Global Private Infrastructure Index. And so what we did is we just took a look and said, well, now what does our composition of underlying holdings look like versus this new benchmark? And what we took away is we have a large overweight to midstream, and we had an underweight to digital, which is things like data centers and other types of digital infrastructure and transport. And so that was a really good beginning point for us to say, well, what do we want to do? And in the last 18 months, we have addressed some of those with some of our new commitments. Okay, the next page just goes over our performance. And look, I went over 106 trillion of potential demand driven by all these secular things going on with energy and with AI. And so lo and behold, look at those top line numbers. This asset class is kind of arriving at it's having its day in the sun, I guess is what you can say. On an absolute basis, you can see all the dark numbers, double-digit performance. The orange is the outperformance. What I will remind you is that the longer dated time periods are a hybrid of the old CPI-based benchmark and the newer benchmark. What I'm happy to report is what you see on the 1 year, that is an apples to apples, just the new benchmark. And fortunately, we are still outperforming. But let me just take you to the next page. And the reason we have this here is, over time, the 3, 5, and 10-year will not be a hybrid of both. The old benchmark will, over time bleed away. And so we wanted to just say, let the board know and manage expectations that the new benchmark, it's the right benchmark to have. It's going to be a higher benchmark. And what you could see is if hypothetically this new benchmark had been in place since inception, well, some of that tremendous outperformance that I showed you in orange on the prior page shrinks. And so really that's the only point of this slide, is to manage expectations going forward. The next page here is our composition versus the benchmark's composition. Look, we've made a lot of changes in the past 18 months with new commitments, and we think that we're going to address some of these imbalances. Sometimes having imbalance is a good thing, and we're not afraid to take active risk, as Bob said we have to do, and NEPC said we have to do. So sometimes we take active risk in managing our portfolio. It has some tilts one way or the other versus the benchmark. And then the next page is by our tilts by geography. And as you can see, we are underweight non-US exposures in infrastructure, and we are actively meeting with managers that have interesting opportunities where they're making investments in developed markets of Europe or the developed markets of Asia Pacific. Okay, I'll get to the fourth and final portfolio, one that probably near and dear to the hearts of most Texans, and that's natural resources. So I think everybody has a sense of what natural resource investing is. The underlying commodities are oil and gas, metals and mining, timber, agriculture. These are private market funds where the managers have a specific strategy. Some, just to give you an example, in oil and gas might just be to buy lower risk, low return, proved developed producing wells. Some might be at the other end of the spectrum where they're going to do more E&P. But it's again private funds that have a mandate that's very specified in terms of what they're going to do. As I mentioned before, we did the same when in looking at benchmarks. Again, the Texas GLO had a consumer price index based benchmark in February of 2024. The board at staff's recommendation adopted the MSCI Global Private Natural Resources benchmark, and so we looked at it, and what we saw is we are, our portfolio compared to this new benchmark is overweight, oil and gas strategies to some of the other strategies in this benchmark, such as agriculture or timber and metals and mining. What we determined is that was actually a good thing. We always are underwriting timber and agriculture funds and metals and mining funds, but we were happy to have this overweight, and but at least now we understand where we sit versus benchmark, and we have a better kind of map for how we want to think about portfolio construction in the future. Just getting to performance. Performance has been good here as well. In the dark numbers are absolute performance, and the orange is our relative performance versus the benchmark. Again, just as I showed a prior slide, this 3, 5, and 10-year is a hybrid of the old and new benchmark. If you switch to the next slide, the same hypothetical analysis is done where we look at what would the portfolio's performance look like versus the new benchmark. It has been in place since inception. And fortunately here you can see we still have outperformance. A lot of that is due, quite frankly, to being overweight oil and gas strategies relative to these other timber and ag. Had we had more of an equal weighting to the index, they would have actually dragged performance down. And then just turning to the next slide on page 41, just letting the board know that we look through our portfolio just like we want to know how much office versus apartments we have. We're very mindful of when our managers in these funds are making investments, where are they investing? What underlying oil or gas commodity type are they in? What basins are they in? How much are they doing kind of operated strategies versus maybe a little bit lower risk return strategies like participating into royalty revenue? So we're always actively trying to understand what our portfolios consist of, and that really shapes our thinking of what we want to do next. Just in terms of forward-looking outlook, I do want to let the board know that you can't pick up a newspaper today without hearing about rare earth critical minerals. China once said they want to be the oil. They want their rare earth industry to be kind of the oil of China, and no doubt the end consumer markets, whether it's base or precious or critical minerals, is important. So we are continuing to look at funds there. This is kind of a proprietary matrix that just shows that, relative to like agriculture and timber, mining and oil and gas still screen interesting. Agriculture and timber is just not meeting, our risk-adjusted return profile. And so I think I could sum up on page 43 this asset, the summaries for both infrastructure and natural resources. And I'd just say from a market standpoint, infrastructure is really walking into its moment right now, whether it's, natural gas pipelines, data centers and artificial intelligence, the need for power, liquefied natural gas. This investment asset class really has a lot of interesting and large investable things coming its way. Natural resources, we'll always have to worry about, commodity price risk, but this industry has fewer players and inventory is scarce. So from an investment standpoint, there are still interesting investment opportunities. I went through our activity and portfolio position, and just think in infrastructure, we will continue to, look at our portfolio positioning versus the benchmark, and we are aware that we are underweighted to non-US markets. They will have to meet our standards to go there, but we are looking, and metals and mining is something that is top of mind for us. And then just on page 44, I probably beat this to a dead horse, but this is just the expectation management of as the old CPI based benchmark is phased out on the 3, 5, and 10-year basis, we'll have a higher bar. And so I am into my closing remarks on page 46. And what I would say about the state of the real estate and real asset program is that it's mature. It's at 11.6 billion of NAV. We are at 20% on a 22% allocation target. It's highly diversified. We diversify by our partners. We diversify, as you know, by the sectors, property type. We diversify by regions, and we diversify by strategy. The portfolio, fortunately, is outperforming across most of the discrete portfolios and across the time periods. I will continue to never sleep perfectly at night when you have real estate holdings that you have that had to go through COVID, office, Europe, but I think it's holding up very well, and I'm certainly optimistic that any new investments in real estate are going to have more tailwinds in their back as opposed to headwinds. And then hopefully you walk away knowing that we, as a team, very proactively manage these portfolios. We really try to stay on top of themes that we think will have more wind at the back as opposed to vice versa. We are willing to be tactical and opportunistic. I mentioned we did 9 co-investments. Those are always fast moving, but allow you to really be nimble. And had a lot of benchmark changes to respond to. As you know, the board approved benchmark, and even in the core real estate, when they opened the aperture to more property types to be included, we're responding to that. And I'll just end that I think we're on the whole more tailwinds than headwinds. And so with Mr. Chairman, that wraps up my presentation.
Well, President, you got a lot going on over there, Nick.
Yeah, love it.
You have to stay late?
Stay late sometimes. I used to dream only about real estate. Now I dream about infrastructure and not as well.
When you have to stay late, it's thick at night.
Yeah.
All right. Any questions for Nick? Any Bob? Any follow-up comment on that?
Well, I just want to commend Nick and his team. Nick, I kind of dropped infrastructure in his lap one afternoon. Suddenly, I didn't ask him. I told him. And he absolutely dove in head first and done the yeoman's job of broadening his skill set and in recruiting Michael Hugh, who's been hugely additive, coming out of the private industry. And I want to give a shout out to Jessica from the GLO. She has flourished in her new role and challenge. So very, very good work in integrating the infrastructure program within this real estate.
No questions? Okay. Members, we're in the short rows. We've been here a little over 2 hours. Try to keep these things around 2 hours. We do have one action item we need to take care of. And then we have committee reports, and so I think we're going to try to set it up and get wrapped up. And so our action item here is the adoption of the board governance manual. Lane, you've had custody of this document. If you will just introduce the item, and then we will take a main motion and then see if there's any pros and amendments and see where it takes us. Okay.
Thank you, Mr. Chairman. Nick dreams about real estate. I dream about good governance. And so here we are. This action item follows work sessions on October 15th and November 5th. And what's presented in the materials is a red line draft dated November 17th. And then there's this summary chart. So within the red line draft, you'll see categories and things. One is obviously red lines. There's some comment bubbles that provide some commentary. But most importantly, there are some highlighted items where folks have proposed one sort of language or another. And so we will need to address those. And with apologies, because we lawyers can't help ourselves. Since 11/17, we have done a little bit further wordsmithing. So we will have a handful of staff recommendations. That's the second category. There's 5 or 6 items in each category. So I think we can accomplish what the board desires to go through this thing relatively quickly. And so I think if it pleases the board to do so, maybe the most efficient thing to do would be to just jump right into that 11/17 draft.
Lane, do you have, so I'm looking at, as I look at this, if it is in blue and underlined, is that a recommended change?
So the way the red line works is red strike through is deleted language, blue underline is added language. If it is simply that without being highlighted in the draft, that is a change that was made in my estimation that had consensus. And so we can talk about everything in here, but in my view, really the only ones that need specific discussion are the ones that are highlighted, and those are highlighted in sort of seafoam green color.
Okay. So what we're going to do, and how many, you've got page 8. It's highlighted in blue, right? And page 11.
Yes, sir.
Okay, so what I'm going to do is that because this is not a work session here in a formal meeting, I'm going to take a main motion.
I move that the board review and adopt the Texas Permanent School Fund Corporation Board of Governance Manual as we did.
Is there a second? Motion is second. Okay. So we now have a main motion, and the main motion is to review and to adopt the governance manual. And so what we're going to do is that so where the strike throughs are, those are additions that we made. Is that correct? In the process, like on page 5, there's a strike through there. That's something that we did, and then there's a just to give you an example, there's a blue underline, and that's what these are changes that have already been made, and they're just reflected. Right.
That's right, and in those particular changes, so where we left November 5th, there was a suggestion of things that the board might approve above and beyond, and so that was abandoned at the work session, and then I had some further discussions with Director Hickman, and we reached what we thought was a good compromise there, and so then that's why that option is deleted, and then the additional language there under B2, and at the risk of complicating this thing, we do have a request to add a footnote, staff suggestion under B3 on page 5. That is our first additional staff suggestion. And what this footnote does, and so the language there in B3 says that the board will review the annual audit and ensure senior management submits it to the LBB. The footnote just describes and adds some color to that process, where the audit plan is presented to the Audit and Ethics Committee no later than the third meeting of the year, and then the fourth meeting of the year, there's a check-in. Then the audit and the annual comprehensive financial report are finalized and filed by December 15th, which is statutory. And then there will be we'll circle back around, and I do have a print up of this.
And that's on page 5?
Well, no, sir, it's on the screen. Apologies, we were finalizing this one right before we went to press. And I have a printout here if you'd like to see it, Mr. Chairman, but that's the language there on the screen. We would propose to add that as a footnote to where it says review on page 5, and then we would reference the footnote again on a following page. And that's just to be clear, this is not a substantive change to anything that happens. This is a clarification of what we mean when we say review, approve, and submit.
Would any member want to propose to add a footnote?
Mr. Maynard, let me just ask real quick. Is this exactly how it's defined as our previous process, Lane? This, just as you were saying, there's nothing new here, correct?
That's correct, Dr. Ellis.
Okay.
It may be in the interest of efficiency on the next page, the same footnote would be referenced under Romanet 4. So maybe we could just have one motion instead of two.
Opposed to move that amendment to add the footnotes there. Okay. Is there a second? All right. Any further discussion? Any objection? Okay, no objection, amendment carries. All right.
Yes, sir. I think next we're to page 8, should be diligent 188. And the first item for consideration was really just the mechanics around what happens in respect of selecting officers for the board, which is chair, vice chair, and secretary. The first option is if no one candidate receives a majority, then the board will repeat the voting process until one does. And then the second option is only the two candidates receiving the most votes would proceed to a runoff. And so
So how that is worded in Roberts is that it's the candidates that have a majority appoint them.
Right.
Yeah, and so, which, we're talking about a 9-member board. And so that would mean if you had 3 candidates, is that I don't think that you would, I don't think you would have anything more than 2, right? So in practice, I think that either one of those would probably work. What would be the pleasure of the board on that?
Mr. Chairman,
Yes.
I'd like to move option A.
Okay. All right. Is there a second?
I second that.
Okay, got a motion and a second to take option A. One candidate receives a majority, then the vote would repeat the process until one candidate receives a majority. Discussion on that? Any objection? No objection, okay? There's no objection, motion carries, okay? Lane, next.
Mr. Chairman,
Yes.
I have one on this same page if it's in order to take it at this time.
What's that?
I have an
Yes.
amendment proposed. It's on page 8, actually.
Okay.
Mine is in B1 at the bottom. And it would be to insert after the first sentence, each agenda shall include language permitting the board to convene an executive session to address time-sensitive matters relating to personnel or real property. Lane, I just emailed the text to you, so you have it.
okay.
It's the only basis for an executive session.
Go ahead.
Well, I think in the bubble, no, I'm good. Nobody can see me. All right. In the bubble, there's some language that was talked about in the agenda, putting catch-all language in the agenda that will allow the board to go into executive session for any reason permitted under the Open Meetings Act. And that was kind of the suggestion to the talk. If we were going to say, put something in the governance manual, I would make it broader to say may go into executive session by the Open Meetings Act or other applicable law. And just make it broader as opposed to just real estate in case there's.
Mr. Chair.
Yes. Would you like to restate the motion?
Well, I just have a question real quick. So before restating. So I think what you're saying is the language that's in that bubble, A12, R11. Is that correct?
That's right, Aaron.
And so just so I can make sure I understand, if that language is inserted, then the board could go into executive session to address a personnel matter. And I'm primarily concerned about something that would happen between the agenda posting and distribution and then the board meeting, that we wouldn't get hung up and have to wait longer to address it.
Under the Open Meetings Act, the board can still only discuss what is set forth on the agendas,
Whatever's posted, right?
whatever's posted. So even if there is something that's in between that's time sensitive, unless we can amend the agenda in a timely fashion, we'd have to repost or do something in that nature. Unfortunately, we can't get around.
Yeah, that was my understanding, so I appreciate the clarification. Mr. Chairman, I'd like to stick with my amendment, and I'd like to speak to it when able.
Okay. All right. Do we have a second on that? What we're talking about is the bubble that's there. To add language there on each agenda, the meeting may go into executive session. And I think that, Aaron, your amendment would give some examples of it.
I can, yes, he sent it to me, I can read it, or he could. Each agenda shall include language permitting the board to convene an executive session to address time-sensitive matters relating to personnel or real property.
Aaron, would you consider maybe expanding that? You know, and I think what we're maybe looking for is kind of like a such as statement. Is that it's anything that's open, allowed for under the open meetings law, such as those two things. And I think that what and I think that the benefit of that is that, yeah, it's anything under the open meetings law act, but a citizen who reads that agenda may not know when you say the open meetings law, well, they don't know what that is necessarily, but if you kind of have a such as statement in it, such as this, then that sort of provides a little bit of clarity what that to the casual reader or the citizen reader, what that might be. Does that make sense?
Yes, Mr. Chairman. So I went and I looked at some of our peers, and TRS uses language that's much more laundry listy. And my intuition and talking, or my takeaway from talking to people in the work sessions was that we didn't desire a laundry list. But what I'm attempting to do is to have it on the agenda so that if an item comes up that should fall under that category, we are able to discuss it without violating the Open Meetings Act. As Chuck kind of explained, it has to be posted on the agenda. So I picked those two examples only because I thought those were the ones that were likely to be time sensitive issues for our fund. If that makes sense.
Will you state what your proposed amendment is?
It's on the screen, Mr. Chairman.
Mr. Chairman.
I mean, I can read it again if you want me to.
Yeah, that'd be good.
Each agenda shall include language permitting the board to convene an executive session to address time-sensitive matters relating to personnel or real property.
Okay. That is the amendment. Is there a second to the amendment?
Is this the?
Yes, I would
Question.
just ask clarification from council. Are we clarifying this is legal according to Open Meetings Act to have that language or to have that basically process?
Yeah, I mean, we could put anything we want onto the agenda. I guess, if you were a cynical observer of this and we had, say, 8 meetings with this language on the agenda and we never did this, you could argue at some point that this was insufficient notice under the Open Meetings Act. But you go ahead, Chuck.
I mean, my recommendation is each agenda should include language permitting the board to convene an executive session for any reason permitted by the Open Meetings Act would be my suggestion, as opposed to limiting it to time-sensitive matters relating to personnel and real property. That just makes it as broad as possible. And that catch-all language is permitted and used for, as put set forth in the bubble, by a lot of public funds as well.
Well, but I want to be sure everybody's on the same page, because there could be a delta, which is the boilerplate that we currently include is tied to enumerated agenda items. And so it has to be a basis to go into executive session to discuss something that's an enumerated agenda item. The legal basis to go into an executive session is much broader than that. And so if you say if the language says we can go into executive session for any reason, we can go into executive session, you could create an argument that we haven't provided sufficient notice. And so, you know, it depends on sort of your Open Meetings Act risk tolerance, right? We could do, as noted, and list every statute that says we can do that. Or we could call out a few, or we could tie it to what's listed on the agenda. So.
Okay. We have a proposed amendment. We still do not have a second.
Second it.
Okay, now we have a second. Okay.
I would, I know I can't make motions. I would make a staff suggestion. If we're going to go this route, I would not favor language that is limiting to just 2 topics. So if it's along the lines of what Chuck was saying. If we're going to go this route, I think we should allow for any basis under the statutes.
Further discussion. Okay. So you see the amendment here. We have an amendment and a second. Any further discussion?
I'm in favor in spirit. Still, it's not clear to me that we are following the law or not following the law or doing what we're supposed to do, but I'm in favor of the concept and spirit. So, is this? I can't. Are we? Is this language? Chuck doesn't favor this language.
It seems to me it's limited.
And I just don't know that that's not necessarily what you want to do to yourself. If you have another issue that comes up that's not these 2 enumerated things, now you're back to square one.
For example, if there was, can we go into time-sensitive executive session matter for attorney-client privilege, something that's listed on the agenda? Somebody would argue, well, your agenda only says personnel or real estate.
Remember, there's 2 things you can do. You can vote to keep the amendment as it is and it goes away, or you can also strike amendment. You can also amend the amendment and by striking out related to personnel or real property, and then maybe perhaps add language that would be inclusive of anything that is permitted by the open meetings law. Okay, those are kind of the 2 options.
It just seems like it's not needed. Why would we want to go here? I mean, the open records are pretty simple.
It is, and by the way, this is a governance policy and related to agendas and then materials. And even if this language is not in here, we can still abstain.
Absolutely, that's my point.
That's well. I'll take it. Any discussion or amendments? If not, we will take a vote on this. Those supporting the amendment, say aye.
Aye.
Those opposed say no.
No.
The noes have it, and the amendment fails.
Mr. Chairman,
Mr. Kinsey.
I'd like to move option 5 above.
The highlighted language right there. And so this was, this just reflects the current practice that we may broadcast regular meetings.
Okay. All right. Second. This is the highlighted.
Yes, sir.
Okay.
Second.
Okay. The motion and a second to offer up this amendment. The corporation may broadcast or post things of regular meeting. In each case, the instances are not required by the text of the laws. Discussion?
Again, can we do this anyway? Just have to be in here.
We can do it anyway. This is what
Why
we're.
do we want to put stuff in here if we can do it?
Point. You don't have to put in your governance policy. There's an option. All right. Those supporting the amendment say aye.
Aye.
Those opposed say no.
No.
Those have it. All right, what is the next decision point, Lane?
Page 11.
Okay.
There is bracketed highlighted language. This is the communication section. And with the bracketed highlighted language, it reads in external communications, comma, where practicable under the circumstances, comma, director should indicate in what capacity they're speaking, etc. It has been proposed to delete that language. As a staff recommendation, I would propose keeping it because it seems to provide flexibility without really much downside.
Would anyone want to make that amendment? To strike where practical? You're suggesting that we strike where practical under the circumstances?
Yes.
Okay.
But to be clear, that was suggested to me. That's not my recommendation.
Oh, that's not your recommendation.
Correct.
Okay. Does anybody desire to make that, to strike that language? All right, we'll keep moving. Where's the next spot?
We are on page 18.
Okay.
Diligent page 198, I believe. So two things here. The first, it had been discussed at the work session that in establishing standing committees, the board chair might seek the advice and consent of the board. This is not required by the bylaws, but it was discussed as an option for potential inclusion.
Does anyone, if anyone made the amendment under 1D, the board chair will generally seek the advice and consent of the board in establishing standing committees. Okay. Does anybody want to propose that language?
Seek advice.
Well, sure.
Yeah, just don't have to take it if you don't like it.
That's right. Okay. There is a proposed amendment. Is there a second? For a second. No second. So the dice for lack of a second. Okay. Right, next spot.
Yep, sir. The next one is a few lines down. We had discussed at the work session that the committee meetings would be the week before the board meeting, and then upon reflection, we thought, well, that really should be 2 weeks before the board meeting, since we have to post for the board meeting that week before, and we have, and we'll get there. It's a separate agenda item and calendar that specifies when we're proposing board meeting dates and committee meeting dates, but generally, with the exception of the December meeting next year, those will be 2 weeks before the board meeting.
Okay, and so this is what we're proposing, and so would anyone care to make that amendment? 2 weeks, okay? Amendment by Cliff, okay? Second?
I'll second.
Second, all right. So this would codify that in our, that our would be 2 weeks before the meeting. And to be clear that it, to the extent that we can do that, I mean, is that I think that there is an instance in December where that's not a possibility, but generally that would be the case.
Lane, you're good with this?
Yes, sir.
Okay.
Any discussion? Any objection? Hear no objection, amendment carries. All right.
Next, go to page 26. It should be 206, diligent. Letter D. My pages may be slightly different. This is the section that says 5 administration, the CEO will, A, B, etc. There it is, D at the top. It says recommend to the board the annual audit. We propose as staff to replace recommend with provide. And this is consistent with that prior footnote that specifies what the existing process is. It's page 206 in diligent. It should be page number 26 in the printed version.
Under legal and legislation.
No, sir, it's under number 5, administration.
Administration, okay, I got you.
The CEO will, and then it's subparagraph D. We propose to replace recommend with provide.
Language is recommend to the board the annual audit and annual comprehensive financial report, which includes audited financial statements and comprehensive information about fund performance. And the proposed staff amendment would be to strike recommend and insert provide. Okay. That's that amendment. Sure. Okay. What makes the amendment?
Second.
And then go second. Okay, discussion on that? Objection. No objection. Carries.
Next page, it's 209 in diligent. It's page 29 in my print. It's under the section that says number 2, performance evaluation process. Then there's A, B, C, and I go down to D. This is the CEO performance evaluation. Okay. So we say there, existing. At the next regularly scheduled board meeting, the board will finalize the CEO evaluation, including and that we propose as staff to insert, bless you, between the word board and will, a comma, taking into account recommendations of the budget and compensation committee. So again, this just reflects current practice. Members may recall that this is what happened at the August meeting.
Take a look. And this kind of reflects what we have already been doing. What was that amendment? All right. Moves the amendment. Is there a second?
Second.
Second. Discussion. Any objection? No objection.
The next one is diligent page 211, and we're getting pretty close to the end here. Right there where it's highlighted, all directors should complete educational training, and what's bracketed is each calendar year. So it could be on some different cadence every 2 years, something different. And so it's just, what is the will of the board is the question.
And to be clear, this would be just our preference, you know, there's no statutory mandate that we do any of that.
That's correct. And we as staff at the corporation will provide some training and some opportunities, but this could be self-study, and that's right. It's not required by statute.
Anyone want to? What was that amendment?
I would say since we generally serve, well, I was going to say 2-year terms. That's not necessarily true for all of us. We strike that just because some of us have 2-year terms as our role on the board and some are 3. So I'd be fine with just leaving it at each calendar year.
Each calendar year is the current language.
Correct.
Okay. All right.
What does that mean?
Should
We've got to read an article of some sort every year. That's the minimum. Yeah, I think that's pretty easy.
I don't hear an amendment to change any of that. It currently says each calendar year. And I don't hear an amendment.
Yep.
So, all right, we'll move on.
Believe, and attached as exhibits to the manual are committee charters. We discussed and reviewed each of the charters with each of the committees this week. And I don't know that there were any recommendations from the committees to add or change language. We can of course find that out, but we do have two staff recommendations. One in the Budget and Compensation Committee, which matches the edit we just made to clarify that the Budget and Compensation Committee will provide a recommendation to the board regarding the performance evaluation and compensation of the CEO, and that would go as a new paragraph B. And again, this charter, it's page 222 in the diligent material.
Yeah. And members, when we create these committees, you know, we created them as we began corporation. I think that maybe over this next year that we may have some discussion about that these may evolve a little bit. And as we have, you know, because we've done a pretty heavy lift on a lot of stuff related to policies and all kinds of things. And I think that maybe that we may have a discussion about what these committees might look like moving forward. But this is what they are today. But I think that is something that I think it would be forward. But we do have a staff recommendation on that one right there, by recommendations. Brett, are you good with that?
Yes.
Would you like, okay. And is there a second?
Yeah.
Okay. Any discussion on that to provide recommendations to the board regarding the performance evaluation of the compensation committee of the CEO? Okay. Any objection to that? No objection. Motion moved.
And finally, Mr. Chairman, it gives me great pleasure to direct our attention to the very last page of this document. We have here is an attachment to the charter for the Strategic Planning and Policy Committee, a schedule for regular review cadence for these policies that are listed. And what's doing a lot of work here is this asterisk footnote that basically says, look, this is the regular cadence to compel us all to pay attention to these things, but we can do them any of these at any time as necessary. And I do have two slight staff suggestion edits. The first one, certificate of formation and bylaws. We had initially thought maybe that would be a good idea to do that in the next year, but upon reflection, I think it makes more sense to just do it along with the governance manual. So we move to delete everything up into the word along. And so it just says along with review of the governance manual.
Would you see the recommended change to strike that language? Anybody care to make that amendment? Close that amendment? Yep. Sorry. All right. Objection?
Objection.
Oh, objection. All right.
I would like to discuss if possible.
Okay.
I'm not sure I'm opposed to it. I just want to understand because I think Member Hickman, who's I guess not here today, had brought up some stuff around the bylaws in the past, but it sounds like we're not going to address those.
So remember the footnote, right? What we're talking about here is regular cadence for review. We certainly
Kind of a minimum.
That's a minimum. That's right. So we could. This is not saying that we can't. It's also, you know, to be fair, we're deleting the language that would obligate us to do it. And so I, you know, frankly feel like this board may have, even though, you know, I have dreams of good governance, and I'm sure this board is very much committed to that. We may have a little bit of policy fatigue at this point.
Yeah, and I think the answer, you know, and we probably should go back and look at those governing documents, the bylaws and the certificate of formation. But if we put that on that cadence, now that doesn't mean that we can't do that until we look at this governance manual again. Is that if we want to do it in 2026 and take a look at that, we can, but then moving forward from there, then when we do the governance manual, we would look at that. So it doesn't preclude, something, this is just to give us a schedule. Mr. Chairman, comment? Yes.
I'm almost thinking a clarifying word in front of review cadence. What we're trying to say here is there's a minimum review cadence that you kind of are obligated to review just frequently. But understanding that at any time, any policy can be reviewed and amended at the pleasure of this. So you're just giving yourself some flexibility, not to force yourself necessarily any faster than you need to. Always do so.
We just don't want these policies to be out of sight, out of mind, and never reviewed. This is, in other words, that we schedule those. And but Mr. Kinsey, that language would not preclude us taking up and looking at the bylaws or the certificate of formation separate.
I understand. Appreciate the clarification. I have no objection.
Okay. All right. Objection? No objection now. All right. Motion carries.
Thank you, Mr. Chairman. The next two are kind of hand in glove, so.
The last page.
Well, there's more than one thing on this page.
Long page.
We lawyers like to bill by the hour and we like our words. And so,
Really now?
well, no, unfortunately not. Or maybe fortunately not. Ethics Policy and Governance Manual. The idea is review each of those every 4 years on alternating when you do one or the other every 2 years. And so that's bracketed. But that's what that accomplishes. We would ask to clarify under investment policy statement, just delete where it says annually, biennially, and say every odd numbered year. And then I had no further changes.
Okay. So the recommendation would be to strike annually / biennially under the investment policy statement and insert every odd number. Any objection? Someone like to make that amendment?
I clarify too, that again, that's a minimum. And we're kind of tying that to the, election cycle and maybe new officers, et cetera. But we are indeed taking up the investment policy in an even numbered year more frequently because we have reason to do so.
This would direct us to do that. Yes.
At a minimum.
We don't want to propose that amendment?
Mr. Chairman, I'll make the amendment.
All right. Well, I'll take you as a second then. All right. Motion by Mr. Thomas, a second by Mr. Kinsey. Any discussion? Any objection? Motion carries.
Mr. Chairman, if I may, I meant to say this in the lead-in, but I think I forgot. As the new guy, this was an incredibly tremendous opportunity and incredibly satisfying opportunity for me to spend some time with board members, thinking through stuff, thinking through various different perspectives on things, and to get to know people. And I appreciate everyone's time and thoughtful energy that they put into that.
All right. That's it. By the document. All right.
Mr. Chairman.
Yes.
I have additional amendments.
Okay.
Let's see. I'm on the PDF page 193, and maybe this is a question that doesn't need an amendment, but I just need clarification on something. Sorry, the PDF is page 13. It was diligent 193. So under the market and portfolio update, or across from that on the description and purpose, says updates the board on significant investment matters not reported in routine reports. What are those routine reports?
Well, we have the posted Bank of New York custodial reports as one routine report that's in everybody's book, and then routinely discuss these things in the CEO comments. So those are two that pop to mind.
I might add NEPC as well. Because it's if you look, it's staff and general fund consultant.
But isn't that what we're talking about? That's kind of my point. I don't think it makes sense. Because to me, this is the NEPC report combined with staff comments on it. And if those are the routine reports, the description doesn't make sense.
I would agree with your observation.
Yeah, maybe we delete not reported in routine reports.
Would you propose to strike the words not reported in routine reports?
I would, Mr. Chairman.
Okay, is there a second to that?
Second.
All right. Motion is second. To strike the language. Discussion. Objections? No objections. Okay. Did you have more?
I do on page 195, and maybe if it's possible, Mr. Chairman, then I can ask a question of staff before making an amendment. Bob, I took some time off of this policy and just tried to look at it with fresh eyes. And one of the things that's come up in discussion in your comments today, in conversations that we've had in committee meetings and prior, was about the bond guarantee program, the work we're doing with the agencies. I'm curious if whatever that turns into on a recurring basis, if that's something that should come to the board and be listed out here, or is that already included in some of these other things?
I think it might be. I think what would be worth maybe isolating is the actual issued reports by the rating agencies. I have been, as a matter of practice, communicating those to you, but I think that is important enough that it warrants being, pointed out as a requirement to do that. And they come out annually, at the timing dictated by the rating agency. But I think it would be appropriate to say that the annual evaluation by each rating agency is a report that, must be shared with the board.
Would that not be under PSF?
Yeah, that's right. Yeah, that's what I was wondering if it was.
Under the bond guarantee program update summarizes the status of school district and charter district bond guarantee programs, including the PSF's credit ratings.
Yes.
Okay.
All right.
The next one's on PDF page 19. It's page 199 in diligent. 2A. And at the end of the sentence there, Lane says each director will serve on one standing committee. I think, help me if I'm missing something, but aren't there provisions somewhere that you can be removed from committees and then we'd be in conflict?
Yeah,
Maybe
the
it's an ethics
bylaws.
policy or something like that. I can't remember.
Chair, under the bylaws, the chair at any time can remove a committee member. I think that's what my notes say. Let me check the bylaws. Yeah, it is what the bylaws say. Any member of a committee may be removed by the chair at any time. And so your point is that language is inconsistent with the bylaws, or it could be if
Correct.
Yeah.
I don't know how to fix it, but that's my identified problem.
I think
Is it sufficient enough that we need to fix it, or do we want to move on?
I think that really that if there would be an instance where somebody was removed from a committee, this would then compel the chair to essentially rearrange the committees. In other words, you'd have to move them to another committee and, keep our membership of 3 on each seats committee. It's just that, I don't imagine, I don't know what the trying to visualize what the circumstances would be that would prompt such a thing.
I think it was, Aaron, you brought it up. I think it is in the ethics policy, just enforcement mechanisms also, because you can't remove something from the board, but just kind of remove them from committees. It's just the punishment with respect to some violation of a board policy. You could modify it to say unless removed under the governance policies of the fund, something along those lines, just unless otherwise removed from a committee.
That'd be your option is I think there's 2 ways to get it. Either you just strike the language altogether and just, or you add a caveat to that is that unless they have been disqualified by removal or something. Notwithstanding.
Thank you. Mr. Chair,
Yes.
I don't want to, Mr. Chair,
Yes.
I don't want to belabor the point if the lawyers don't think it's a conflict. I was merely bringing it up because I remembered it being potentially a conflict at some point.
I think if it states otherwise that you can remove them, I think that's sufficient. It's not.
Do you have anything else?
Yes, Mr. Chairman. On page 22, 202 and diligent. At the bottom, let's see. 3A2A. Maybe further down. Some of the governance and board operations section. Right there where it was highlighted CEO will.
Right there.
I thought there was, we had some proposals that were pending on this. Did you say those were wrapped up or?
So the PDF document says promptly inform the board in advance of anticipated, et cetera. Is that what you're getting at, Mr. Kinsey?
Correct. There's 2 proposals listed out. That was one of them.
Those are, if you scroll down a little further under D, those are now Romanet 1 and 2. There they are, right there.
Okay, thank you. My next one is on page 205, PDF page 25. And Mr. Chair, I think it's a process question I have for you related to the ASF distributions.
Okay.
So it says, well, see if I can talk you to where I'm looking. It's under available school fund distributions, section 4. So in B right there, not later than November 1st of each even numbered year, submit to the legislature, comptroller, SBOE, and LBB a report that in detail specifically states the date of the transfer, et cetera. So that's only the date. That doesn't, that's not the amount, the final amount that's determined by the SBOE.
This is the 5G distribution actually. So
oh,
this
okay.
is,
That was my confusion.
reference to 5G, not 5A.
Great. My next one is on page 211. It's page 31 on the PDF I have. And it's under new director orientation. Number 1. So I propose, or I move that at the end of that, after corporation, we add a comma and say, as well as the current investment allocations in the IPS.
Is there a section?
Could you scroll down so we can see what's?
And all board level policies.
Aaron, you're just making it part of the CEO briefing.
Mr. Chairman?
Yes. Aaron, I was
my intent was just to make it a part of the CEO briefing as one of the 2 biggest things that we do. I am aware that further down the document, we ensure that they get those policies, but it seems like it's a great time for us to have a conversation about what the portfolio looks like for a new director to set them up for success.
You see the amendment? Is there a second to the amendment? All right. Any further discussion? Let's speak to your motion further, Mr. Kinsey.
No further.
Is there any objection to the amendment? No objection. Amendment carries. All right. Anything else?
Yes, Mr. Chairman. 213, PDF page 33, Exhibit 3. Underneath the investment policy and asset allocation, I would propose that we add securities lending.
Amendment is to add in that list securities lending. Is there a second? Okay, motion and a second. Speak to your amendment, Mr. Kinsey.
I believe in talking to some of the staff that the intent is to start to fold some of these things underneath the investment policy. This board has spent time in the past on the securities lending policy. At least 2.5 years ago, we spent some significant time on it. So I would just propose that we add it to the list. Yes, I realize it's a guideline, but I would just like to call it out.
Is there any objection to the amendment? No objection, amendment carries. Okay. Anything else?
I do, Mr. Chairman. The last one here, I think, is on page 224. It's the last page, whatever your last page is, Lane. The Strategic Planning Policy Committee Charter. So the one right before that, I think. So it actually starts. I would like to add a new 3. Will be my my motion, and then renumber subsequently. And 3 would say investment policy statement, parentheses IPS. regularly monitor the effectiveness and efficiency of the implementation of the IPS and associated risk thereof.
Let's take that again. One more time.
Sure. Regularly monitor the effectiveness and efficiency of the implementation of the IPS and associated risks, plural, thereof.
Second to that.
I'll second it.
Can you speak to your amendment?
Thank you, Mr. Chairman. As I step back, I know you said we're going to potentially at some point in the future look at new committees and things like that and fully understand your plan on that. And when I think about what we're not covering in the committees as they're currently set up, it is things around the IPS implementation. And so I'm looking for a home for this. I asked staff last time, I think at least one, maybe two other board members echoed as well during the work session to look at what other funds, our peer funds have done. And it seems as though at least two of the three have some sort of committee where this is monitored and things are brought up related to risk to really deep dive and understand how it's all being implemented. So my proposal is to bring us in line with our peers and increase oversight and communication between the board and staff related to these topics.
Any discussion, questions? Any objection to the amendment?
I object to it.
Okay, we have an objection. Okay.
Me too.
Okay. To speak.
I just think, I don't disagree with part of the spirit, but I think it's, if it needs a committee, then what this committee is already doing, which is fairly broad and a lot of responsibility.
Mr. Chairman, I missed the audio on Mr. Wright's comments.
Can you hear me?
I can. It just cut out in the middle of your comments.
Yeah, I just said, I don't disagree with the spirit. I think if it warrants a committee, then it should just be a standalone committee, and the scope of what the current mandate of this committee is already pretty broad and comprehensive.
We're going to go ahead and take a vote.
Mr. Chairman,
Yes.
can I respond?
Yes.
I don't disagree with what Mr. Wright's saying at all. Actually, I was just trying to work within the bounds of the guidance that the chair had provided, that we would stick with these three committees. If somebody believes it fits somewhere else, then I'd love to discuss that as well. But I think that we have a duty to do this somewhere in the committee where there's more engagement.
We'll commit to you, Mr. Kinsey, that we will actually take a look at studying the committees and after the first of the year and begin to have that discussion sooner rather than later. I will commit to that. Okay. Right. You've heard the discussion. Those supporting the amendment say aye.
Aye. Aye.
Those opposed say no.
No.
All right. Let's take a show of hands. Those supporting the motion, please raise your hand. 2, 3. Okay. Those opposed, please raise your hand. 2. The chair is going to cast a vote in the negative on this. And the vote now is 3-3 and the amendment fails. All right. Anything else, Mr. Kinsey?
No, Mr. Chairman, I'm good. Thank you.
All right. Members, we have reached the end of that. Is that we are now back to the main motion, which is the adoption of the governance manual. And if there are no further amendments or further discussion, those supporting the main motion to adopt the board governance manual say aye.
Aye. Aye.
Those opposed say no. Ayes have it. Motion carries. Congratulations. And Merry Christmas. All right, very quickly, let's run through the committee report.
Sure.
Right.
The Budget Compensation Committee convened yesterday morning. Myself, Chairman Maynard, Member Stanislaus, and several members of staff. We heard similar update from the CEO on the bond guarantee program and a little more fulsome detail around all the work that's been done with the rating agencies and the process of modeling. The bulk of the meeting we spent talking about the budget and appropriations process, which is sort of a evergreen, living, breathing process. We're talking about an itemized budget that's due for 2026 in the near term, and then we're also already looking at 28, 29 biennium. Talked about some of the various staffing and strategic planning implications of the budget, which ultimately supports the team, the build out of systems and processes. One item that we discussed is the use of a modest portion of our unexpended balance in this year. Overall,
Got a lot of MR.
projections we're at right now, we would still be at a low expense ratio relative to our peers, and in keeping with what we talked about as being a low cost provider. We also reviewed the committee charter, which we just reviewed, and then as well the agenda for the upcoming meetings.
Questions for Mr. Chairman Wright? Okay.
Yeah.
Chairman Kinsey.
You're on mute, Chairman, Mr. Kinsey.
Thank you, Mr. Chairman. We had also started with remarks from Bob, exact same as Brad just reported in his report. Then we did the proxy update and the report out, which the board received earlier today. We looked at the strategic plan and deep dove into that with Needy to understand the efforts to further professionalize the organization, share strategic focus for 2026, and look at the recent progress against major initiatives and also our way to communicate between the committee and staff on those initiatives going forward. Appreciate the work from that team on that. We looked at the governance manual that we just passed. We also looked at our charter as well. And then finally, we talked about the proposed agenda and projected calendar for upcoming meetings. No action was taken.
Chairman Ellis.
Yes, we also had the remarks from the CEO. Our next item was the annual risk assessment. We had KPMG provide an update on their financial report. Audit's gone smoothly so far with no significant findings to date, and they are expected to issue their opinion on the PSF financials next week. We had remarks and updates from our chief audit officer, discussed the post-payment audit for fiscal year 2025. Process expected to take 2 to 3 months. Should be ready for our second quarter board meeting. Team reviewed the 2025 internal audit plan results, which completed 3 completed audits that all had a satisfactory rating. Received a compliance update from Mr. Arnold. And we had a discussion on the new ethics policy with a 100% completion rate for training. Team has expanded its compliance capabilities, leveraging internal resources with plans to elevate Brianna to a senior role in compliance. Also implementing various software solutions for pre and post trade compliance. Reviewed our committee charter review. We were provided with an overview of the proposed changes to the charter, which we discussed earlier today. Had a cybersecurity update, gave some data on that. One thing I wanted to bring up is that staff offered all of the directors an opportunity to have them help with dark web monitoring for each of us as individuals. They can monitor our email addresses. And if there's anything related to us on the dark web that might be connected to the PSF, they can provide us that information. So if anyone is interested in that service, I would direct them to contact staff about that. And then last was the review of the proposed agenda for the upcoming year. And that'll be discussed, I think, in our next item. And also no action was taken.
Any questions, Mr. Chair Ellis? All right. Thank you, Dr. Ellis. Thank you for always for your good work. That's a lot going on there. All right, last thing. Sir.
Go ahead.
Go ahead, Bob.
Well, in keeping with the feedback from the board about the cadence and occurrence of the committee meetings, and not having them fall the day before the board meeting, what we proposed, and I think is found acceptable to everyone, is that we have them 2 weeks before, which gives us adequate time should anything propagate from a committee that then affects the board agenda and associated materials, to incorporate that and have that, timely put together and submitted for the board meeting. So 2 weeks seems to fit that. We've laid out that proposal for the first 3 meetings of the year, the exception being the December meeting, which is immediately preceded by Thanksgiving, which is immediately preceded by the Board of Education meeting. So in that case, we're proposing having it 3 weeks before the board meeting. So just wanted to propose those changes, hopefully get them approved so we can all calendar accordingly.
So Mr. Board, we've already approved all of the dates. And so the only thing that would change is that the committee meetings would be 2 weeks ahead of that. The exception would be is that for the December 2026 meeting, it would be 3 weeks before because of the Thanksgiving and the SBO, and so we go 3 weeks ahead. Okay. Does anybody have any objection to that?
My understanding is we will need a formal motion because you have previously approved set dates.
Well, to be clear, that we just approved a governance policy that sets all everything 2 weeks ahead, right? And so the only thing we would need to do this is that we would need to create an exception to what's in policy, and that is that the motion would be that the committee meetings preceding the 2026 December 2026 meeting would be held 3 weeks in advance of the meeting date. Right?
I think that works, yes, sir.
Make that motion?
So it's the November 12th. So I move that the board approve the following, I move that the board approve November 12th, 2026 as the committee date for the December committee.
Second? Second? Objection? No objections. It is done. Okay? All right. Anything else? All right. Members, thank you and Merry Christmas. Happy New Year. We will see you next year. Thank you for your service. It is not a high-paid job, but it is an important job. And thank you for the work that you do, that you are planting trees under whose shade you may never sit. But the work that you do matters.